and we don't have regulatory arbitrage. So we want to make sure that the banks, the credit unions, and others that are involved in this, their voices are heard. The civil rights groups, the low and moderate income communities, that they get their fair share. So that's what this is all about.
Do we need new legislation, or can that be done through regulation? And the OCC, as I understand it, really administers this. Can the Office of the Comptroller of the Currency take care of this for you?
Well, yes, this is not right now legislation that's being proposed as regulation, but we would hope that the regulation would be with all three bodies that oversee it. That's the OCC, the FDIC, and the Fed. So again, so that they would come together with one idea, so that no bank can pick and choose, whether they want to be regulated by the OCC or whether they want to be regulated by the Fed, or whether or not, the size of the bank. If you are under $500 million, then you're exempt. We think that it should be all three of the regulatory bodies should get together, come up with what they think is the appropriate regulation and move forward. And we also think, and the big problem we had right now, which what we discussed at the hearing, was that the OCC only want a 60-day comment period. We think it should be a 120-day comment period because it's important to get right.
Okay, Congressman, really appreciate your time today. Really appreciate it. That is Democratic Representative Gregory Meeks of the state of New York. And be sure to tune in on Tuesday for our special coverage of President Trump's State of the Union address. That kicks off at 9 p.m. Eastern Time here in New York. Still ahead here, the so-called public option has become a policy haven for more moderate Democrats. But would it work? We asked Lanny Chen of the Hoover Institution about his new research next. This is Balance of Power on Bloomberg Television and on radio.
Message and data rates may apply. T&C and privacy terms can be found at babbel.com/terms. Please don't text and drive.
Have you wanted to speak a new language, but you thought it'd be too hard or take too much time? Then try Babbel for free by texting EXPLORE to 64,000. In just 15 minutes a day, you'll be on your way to speaking a new language in just a few weeks. And right now, you can try Babbel for free. Babbel starts out teaching you words and phrases by matching them with pictures. You won't believe how easy the interactive program is. Soon the sentences get a little bigger, and before you know it, you're having simulated conversations voiced by native speakers. And because Babbel is crafted by language experts and uses the spaced repetition method, in just 10 to 15 minutes a day, you'll be speaking the language of your choice with real confidence. With Babbel, you can speak a language. Just text EXPLORE to 64,000 and start your first lesson in the language of your choice for free. Download the Babbel app or text EXPLORE to 64,000 and try it for free. Text EXPLORE to 64,000.
Tom has been a teacher for over 40 years. One day, I think one of the students had asked the question and he didn't remember the answer. And I also noticed that he was letting his class out earlier than they were supposed to let out. I was really starting to worry.
Levi and I talked about how it would change our lives, but he was there beside me.
When something feels different, it could be Alzheimer's. Now is the time to talk. Visit alz.org/ourstories to learn more. A message from the Alzheimer's Association and the Ad Council.
Our relationship with Asia is simple. Find the most experienced journalists.
These countries will need each other more and more in the future.
Let them gather the best data and experts.
Let's get to Singapore now and our guest.
Then bring everything they find straight to you.
Let's talk about where you are. There's quite a lot of headwinds there too.
Actually, it's not simple. It's just better. Bloomberg Daybreak Asia, tonight at 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Healthcare helped Democrats win back the House majority, and the issue has figured prominently in the presidential debates throughout the Democratic primary, with moderates like Joe Biden and Pete Buttigieg offering what they call a so-called public option as a more incremental alternative to the Medicare for All pushed by more progressive candidates like Bernie Sanders. Hoover Institution fellow Lanny Chen has studied the question and has some big reservations about public option. He comes to us now from Sunnyvale, California. So, Lonnie, thank you so much for being here. Tell us what your study showed, because we thought this was a pretty benign alternative.
Yeah, I think that's the general view, David, but the reality is if you look at the public option over time, and there are a variety of reasons why this is so, it actually ends up adding a significant amount to the federal deficit and to debts over time. What you find actually is over 10 years, the public option proposal adds about $700 billion. And if you look out even further, over 30 years, it has the possibility to become the third largest government program behind Medicare and Social Security. And, again, a variety of reasons why this is so. But for those who see the public option potentially as more moderate, this study is a warning sign that, in fact, it may not be what they thought it was.
So as we look at this clash out in Iowa and then New Hampshire going on in the primaries, should people be asking, for example, Joe Biden, how are you going to pay for it, the way they were really pressing Elizabeth Warren about her Medicare for All?
Absolutely. I think it's an important question. Now, Joe Biden has said, and he's got a broader health care proposal that includes a public option, also includes some enhanced subsidies under the Affordable Care Act. He has talked about paying for that by increasing corporate tax rates, potentially increasing individual income tax rates on high earners. But one of the things we found in this study is that that alone is not going to cover all of this cost. I think they're dramatically underestimating how much these sorts of proposals are going to cost. So absolutely, in the same way that Senator Warren was pressed on her Medicare for All plan, I think that Vice President Biden and Pete Buttigieg and others who are proposing a public option should also be asked about how they intend to finance this over time.
And what would the public option do to Obamacare?
Well, I think that's a big question, right? One of the things that we note is that if you have a public option operating in an attractive way, you end up with about 1 in 3 Americans, over 120 million Americans on this public option plan within a few years. And that would eat into, in some ways, the markets that Obamacare tried to create. So it's an interesting question of the interaction between the public option and Obamacare. And in fact, if you can argue, as Joe Biden has, that somehow he's shoring up Obamacare while also creating a public option, I think this study does raise some serious concerns about the impact of the public option on existing choice and competition in the marketplace.
Lonnie, you're a policy guy. I always have been. One of the things we really like about you a lot is policy. How much would these policy choices really factor in Iowa and going on to the other primaries? For example, we have a Monmouth poll out today, for example, saying basically it's neck and neck between Bernie Sanders and Joe Biden, who have very different policy approaches on a number of things.
Yeah, and I think what you're seeing there, David, is you're seeing that there are two parts of the Democratic Party that are battling for ascendance or battling for control of the party right now. One is obviously the progressive wing, which Bernie Sanders and Elizabeth Warren are part of. Sanders has managed, I think, to consolidate some support there. And then you've got the more moderate wing led by Joe Biden. And at the core of their dispute, at the core of their policy dispute, really is health care. I mean, this is a subject that was part of many debates they've had already. You see that Joe Biden and Pete Buttigieg are trying to propose this supposedly more moderate public option in comparison to the more dramatic Medicare for All overhauls that Warren and Sanders are proposing. So I actually think health care is going to play a huge role in resolving this Democratic primary contest. And in fact, in the general election, I do see it being a significant issue when whoever the Democratic nominee is goes up against President Trump.
And that is my question, because you were a policy guy, but you were a policy guy for Mitt Romney when he ran for president. So if you're running some campaigns here, as a practical matter, how can the Democrats get this back to health care? And how can President Trump keep it over in the economy more generally? Because if you look at the polling, President Trump gets a lot of credit for the economy, jobs, things like that, but on health care, not so much.
Yeah, healthcare has been a trouble spot for not just President Trump, for Republicans generally over the years in campaigns. I guess what I would say is for President Trump, he's got the signing of the USMCA today. He's been focused on the economic message to the extent that he can be. That's really what he needs to do, is to use his bully pulpit to amplify that economic message. I think for Democrats, the challenge is how do you run against an incumbent president with a good economy? And the answer is you go to issues like health care, pocketbook issues that people are still struggling with. And I think, David, to a certain extent, there is still a sense in some parts of the country, even though the economy is doing very well, that individual workers and individual families may still be feeling like they're not getting ahead. I think that's going to be what Democrats have to seize on.
That's that pesky issue of distribution. Okay, thank you so much to Lonnie Chen out at the Hoover Institution. And a reminder, we're going to be out in Iowa for live coverage on caucus night. That's going to start at 10 p.m. Eastern Time. Coming up here, we hear from Democratic candidate for President Andrew Yang from out on the campaign trail. Our own Joe Weisenthal, co-anchor of What'd You Miss, caught up with him out in Iowa, and he's going to tell us exactly what he wants to do in terms of policy and how he's going to win the Iowa caucus. That's coming up on Balance of Power on Bloomberg Television and on radio.
This is the Bloomberg Money Minute. Stocks in general are rising, but investors are still worried about coronavirus. Starbucks shares are falling after it revealed it had closed more than half of its more than 4,000 locations in China. The Dow is up 107 points, S&P up 10, the Nasdaq up 30. Apple stock is at a record high. The company sold more iPhones, AirPods, and wearable devices over the holidays. Contracts to purchase previously owned homes fell in December by the most in almost a decade. The National Association of Realtors says lean inventory is driving up asking prices. And a record 26 million people are expected to bet on this year's Super Bowl, according to the American Gaming Association. 6 states have legalized sports betting in the past year. Donna Wilson, Bloomberg Radio.
Why has J.D. Power ranked Commonwealth Financial Network #1 in independent advisor satisfaction among financial investment firms for the 6th straight time? We think it comes down to one thing: you. Because it's your input and feedback that keeps us focused on what's most important to you and your clients and continually pushes us to be the best we can be. Maybe that's why we receive top marks in every category of the J.D. Power 2019 Advisor Satisfaction Survey. They named us #1 in client support, #1 in firm leadership, #1 in operational support, #1 in compensation, #1 in professional development support, and #1 in technology support. Ready to partner with the best? Call Commonwealth at 866-462-3638 or visit commonwealth.com and feel the power. Member FINRA SIPC, a registered investment advisor. For 2019 J.D. Power Award information, visit jdpower.com/awards.
Okay, kids, Dad's gonna teach you how to dance. First, spread your feet apart. Then, pump your knee, nod your head, shake your hips, and bite your lip ever so slightly. Now, with one hand in the air, point at people with the other hand. I call that the rock star.
Dance like a dad. It's a great way to make a moment with your kids.
Now, make a face like it just smells something bad.
Visit fatherhood.gov. Brought to you by the U.S. Department of Health and Human Services and the Ad Council.
Revisions, return policies. There are so many ways to redo a decision.
What are the ramifications if she crumbles or doesn't crumble?
Do they have any path other than the courts?
Except here, we have to get it right the first time.
We always talk about the losers in a trade war. Are there winners?
So that you can too.
How does your modeling have to pivot to reflect a different scenario?
Bloomberg Radio, the Bloomberg Business, Radio.com, iHeartRadio apps, and BloombergRadio.com. Bloomberg, the world is listening.
From New York, this is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, President Trump signed the new U.S.-Mexico trade agreement into law today, ending what he called, quote, the NAFTA nightmare. The president made renegotiating the North American Free Trade Agreement a priority during his 2016 campaign for the White House. Mr. Trump called the new pact a cutting-edge, state-of-the-art agreement that protects, defends, and serves the people of the United States. No country in the world is fully prepared to handle a major disease epidemic or pandemic. That's the grim conclusion of the latest Global Health Security Index. The report finds national health security is, quote, fundamentally weak. 13 countries are the most prepared for disease disaster. The U.S. is first, followed by the U.K. and the Netherlands. China ranks at 51. The WHO Emergency Committee will meet again tomorrow to decide whether the coronavirus should be declared a public health emergency. A senior Israeli official says a cabinet vote to endorse annexation of parts of the West Bank will not happen early next week. That despite Prime Minister Benjamin Netanyahu's pledge a day earlier to act quickly after the U.S. released a plan to end the conflict. Israel's tourism minister told Israeli radio that the proposal must first be brought before the Attorney General. Palestinians rejected President Trump's Middle East plan. SpaceX today launched its 4th batch of Starlink internet satellites. 60 of the satellites were sent into orbit. They'll deliver internet service to locations where access has been expensive, unreliable, or absent. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg. David?
Thanks so much, Mark. The USMCA is now law in the United States of America after President Trump's signing ceremony earlier today, having garnered rare and broad bipartisan support in the end. Welcome now one of the members of the USMCA Republican House Whip team. He's Congressman French Hill of Arkansas. Mr. Congressman, thank you so much for joining us. Really appreciate you being here.
So, you bet, David. Thanks for having me.
So you're not just a congressman. You weren't just in the executive branch, but you also are a businessman, and you were a banker yourself. Give us a little insight into your constituents back in Arkansas. What will this mean for them?
Well, look, Arkansas has over 100,000 people, David, that are employed due to trade with Canada and Mexico. So Canada and Mexico are our most important trading partners. Ending the uncertainty about NAFTA is important. Modernizing NAFTA is important. Opening up the dairy market in Canada is a plus. But I think we'll see Arkansas at the crossroads of continued growth between exports and imports between Canada, Mexico, and the United States.
So when you look at Arkansas, is Canada and Mexico, and maybe one or the other, much more important than, for example, Europe or China and some of the other places we talk about?
It really does dominate. I mean, we see manufactured goods and farm products, foreign products going both ways. A lot of the chicken grown in Arkansas goes to Mexico. A lot of the rice grown in Arkansas goes to Mexico. So both in agriculture and in manufacturing, NAFTA's improvements, now the USMCA, are critical.
So get our hopes up here a little bit, if you would, Congressman. We've got some bipartisanship that got some stuff done even in an election year.
Yeah.
Is there anything else that you could get done this year, you think? I mean, drug pricing, infrastructure, anything else that maybe you could get done?
Well, we're definitely going to work on a new highway bill in 2020. Every 5 years, we do a new highway authorization bill. That's an opening for some infrastructure compromise. I think also you mentioned drug pricing. House Republicans have H.R. 19, which is a way to make drug pricing more competitive. Senator Grassley's worked on ideas in the Senate. So it could be a possibility of a more narrow drug pricing bill that would make prescription drugs more affordable for our families and maybe have improvements for our hometown pharmacies that have really suffered too. So these are areas that could potentially have a surprise positive in 2020.
So, Congressman, I mentioned that you're a former banker and you're also on the Financial Services Committee. Give us a sense of what's going on with some of the liberalization, some of the rules under Dodd-Frank, because there are various incremental changes I know being made.
Well, last year was a big year. On the 10th anniversary of Dodd-Frank, we were able to modify so many of the rules through Senate Bill 2155, which organized and reduced regulatory burdens that we think were overblown in Dodd-Frank. But we have coming up the regulatory proposal to improve covered funds and Volcker. This is a big issue. Volcker harmonization is something that's important to companies of all sizes. When you have Jay Powell, now chairman of the Fed, but as the Fed governor said, the Volcker rule is so confusing we can't really enforce compliance with it, and it sometimes takes a Ouija board to figure out how to comply with Volcker. So this rulemaking is something the industry is really looking forward to studying, and I do too.
So one of the things we heard about early on with Dodd-Frank, and this was including from some of the regulators who proposed it, said, you know what, we went too far when it came to community banks. That there are different situations depending how big a bank you are. You were a community banker. Has that largely been fixed now? Because I know there was some new legislation.
Right. It is better. The rules are tailoring all the compliance rules, both the CFPB type rules, the Consumer Financial Protection rules, and safety and soundness rules. There was more tailoring in 2155. This helps both community banks and regional banks modernize and affect their costs, lower their costs. So I think it's an improvement after 10 years of Dodd-Frank. But the one big area, David, that we have not satisfactorily dealt with is the secondary mortgage market. Fannie Mae and Freddie Mac were the principal contributors to the crisis in the mid-2000s that led to the recession in 08. And I'm hoping that Congress will work hard this year on consensus on how do we modernize and fix the broken secondary mortgage market with Fannie Mae and Freddie Mac.
Well, I think you said the magic words, which is consensus. I know the Treasury Department, Secretary Mnuchin, has a proposal out on Fannie and Freddie. At the same time, it feels like almost a third rail. They put that thing into receivership more than 10 years ago. It's supposed to be temporary.
Right.
But nobody wants to touch it because they're afraid it might affect the mortgage market and affect homeowners.
It's important that whatever we do be done in a way that maintains the liquidity in the secondary market, maintains affordability, maintains access for originations to be sold in the securities market. But my concern is that Fannie and Freddie now dominate that market, and the private sector has been fully squeezed out of the secondary mortgage market. That was not the intent of Fannie and Freddie. So I think the reforms that the FHFA ably led now, and the ideas that Secretary Mnuchin has proposed, these all need vetting in Congress. And let's see if we can't find a solution to 10 years of conservatorship, which is no way for us to maintain a healthy and safe mortgage market.
Okay, thank you so much, Congressman. Really appreciate you being with us. That's Congressman French Hill, Republican of Arkansas, coming to us from Capitol Hill. And coming up at 2 o'clock this afternoon Eastern Time, we will give you full coverage of the Fed decision on rates. And now we have breaking news. The European Parliament has overwhelmingly backed the Brexit deal. That clears the way for the United Kingdom to leave the European Union on Friday, the way Boris Johnson, the Prime Minister, promised. So that's coming up now. They've signed it. Actually, they seem to be holding hands and singing right now in the European Parliament as they voted for the United Kingdom to leave. Coming up, Andrew Yang is hoping his message of universal basic income catches on with Iowa voters. We hear from the candidate in Des Moines. That's coming up next. This is Balance of Power on Bloomberg Television and on radio.
You're not supposed to.
Hey, have you heard? The Mayor of London has launched his latest van scrappage scheme to help tackle London's toxic air. Small businesses or sole traders like me with a polluting van could now get £7,000, which you could use to trade up to a Euro 6 vehicle. And you could get an extra £2,500 towards running costs if you go electric. The scheme is now even easier to qualify for, and it's open to any businesses with up to 50 employees, like mine. So, I'm going to search TfL scrappage to see if I'm eligible and apply. You should do the same. To the Mayor of London and TfL, every journey matters.
TalkTalk Business Superfast Fibre. Great value at just £21.95 a month. For butchers and bakers and selfie stick makers. With a 365-day UK contact centre. Rated great on Trustpilot by builders and brickies, accountants and techies. Average speeds of 67 megabits per second for party performers and takeaway corners. Fibre broadband for every business. Great value at just £21.95 a month for 24 months. Excluding 20% VAT with no connection fee. TalkTalkBusiness.co.uk. T's and C's apply.
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
You might already know that TuneIn allows you to listen to all the pro sports leagues wherever you go. But did you know TuneIn is also home to the wide world of college sports?
Open three, DeAndre Hunter got it! Handoff Carruthers, big hole right side. He leaps and he surges in, touchdown!
From live college football, basketball, and baseball games to podcasts and coaches shows fueling your love for the game in your school. And the best part is, it's all free. Search college sports to find your team or league.
Start hearing more of what you want.
Upgrade to TuneIn Premium and get over 45 commercial-free music stations,
Live commercial-free news,
and every live NFL, MLB, NBA, and NHL game.
Visit TuneIn.com/premium to upgrade.
TuneIn is your ticket to on-the-glass NHL action. With the NHL on TuneIn, listen to every one-timer, hear every stick save, and experience every goal for every team across the league.
Featuring home and away feeds for all 31 teams.
TuneIn brings the excitement of the NHL home to you all season long. Plus, with NHL On Demand, skate back in time and relive the best moments of the season while listening to past games in their entirety. Listen to the NHL on TuneIn.
Search NHL today.
TuneIn remembers the life, the success, the legacy of Kobe Bryant.
Buckle up for Kobe Bryant!
5-time NBA champion.
It was my dream to be a Los Angeles Laker.
The Lakers repeat back-to-back titles.
Devoted husband and proud father of 4 daughters.
I love having girls. They're awesome, man.
People are in disbelief that this global and cultural icon could be gone.
Search Remembering Kobe Bryant on TuneIn for podcasts and interviews of the legend, Kobe Bryant.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
When you're not listening to your team, take it to the end zone, the rim, or the net. Keep up with the biggest moments in sports by following TuneIn on social media.
Block, Cook into the end zone for the touchdown.
From reminders of the live top games to tips of the best sports stations and podcasts.
Welcome to Undisputed. We are live from Los Angeles. I'm Jenny Taft here with Skip Bayless.
Follow at TuneIn on Facebook, Twitter, and Instagram to get the most out of TuneIn.
Go courtside with the NBA on TuneIn. With the NBA on TuneIn, hear your favorite team and players take on their biggest rivals during the biggest games throughout the year, including regular season showdowns, the 2020 All-Star Game, and the NBA Finals in June, featuring the home and away calls for all 30 teams. Plus, with the NBA on demand, relive the best moments of the season by listening to the past games in their entirety. Listen to the NBA all season long on TuneIn.
Want to know a quick, easy way to see if your favorite podcasts have a new episode available? Just go to the home screen on your TuneIn app and see the latest editions under the Your New Episode section. Happy listening.
Cash benefits. What would people have to give up in order to be eligible for the Freedom Dividend, which, as you say, is opt-in? And why make that an opt-in choice? Why not just allow people to keep what they have in terms of cash benefits for things like food stamps and then get an extra $1,000 a month on top of it?
Well, the vast majority of Americans would just see $1,000 a month increase in buying power. The only people that might have to make a choice are people who are receiving direct cash assistance for things like heating oil or food stamps. And in those cases, virtually none of them are getting $1,000 a month right now. So this is a huge win. And when I talk to people who are recipients of these programs, they live in constant fear of losing their benefits, of failing to meet some administrative or reporting requirement. So if they were getting a stress-free $1,000 a month, it would be a massive upgrade. And it also has no negative incentive for them to make more money, because right now our assistance programs are predicated on you being below a certain income level.
Let's talk about some non-UBI topics. Every debate that I've seen, that I've seen seems to start off with some 30-minute discussion about healthcare, and I think a lot of people tune out or their eyes glaze over. But there does seem to be some ambiguity about exactly where you stand. Would people be able to keep private insurance under an Andrew Yang ideal healthcare system, or would it be a single-payer, single sort of system, more like what Bernie Sanders has proposed?
We need to have universal health care in this country that's not linked to your job, because right now linking it to your job is not a great system on many, many levels. But I would not legislate away private insurance. Millions of Americans enjoy their private insurance plans. They made choices based on those plans. To me, the onus has to be on the government to demonstrate that we can do a more effective job than private insurance companies and have Americans make that choice for themselves over time.
Your campaign has, you've advocated legalization of marijuana, and you actually sell merch with cannabis leaves on it. We're sort of at this weird juncture where there's a lot of momentum towards liberalization of marijuana use. At the same time, there is an incredible crackdown on things like nicotine, vaping, and cigarette use. Vaping, tobacco use. I'm curious if you think that makes sense, and do you think it, under your administration, would you continue to tighten the regulations about, say, flavored vaping products at the same time as liberalizing people's access to marijuana?
Well, the flavored vaping products seem to be marketed towards young people and kids in particular, and there have been a number of deaths as a result of these products. So to me, legalizing marijuana and our treatment of those products are actually two very different questions. Marijuana has been very, very effective as a means of pain relief for many, many Americans, and it's less dangerous, frankly, than the prescription opiates that have been killing Americans in record numbers for years now. So that's why I'm for legalizing marijuana, but to me, we have to figure out how to not have these vaping products marketed to kids, and how to ensure that they're not literally causing deaths among young people.
But should adults be able to enjoy flavored vaping products, their Juul pods and so forth?
Well, if we can balance the public health concerns and individual agency, I'm not for an outright ban.
That was part of Joel Weisenthal's interview with Andrew Yang earlier today. And we about an hour for live coverage on caucus night. That starts at 10 p.m. Eastern Time. It's time now for Stock of the Hour. GE is surging towards its best day since October. The stock is up around 10% after its fourth quarter report showed that the company's turnaround just is finally working, perhaps. Kaylee Lyons is here with more. So a good day for GE.
Yeah, Larry Culp maybe finally getting some things done. And really, GE, as we know, is largely a cash flow story, as this is a very highly leveraged company. And in the fourth quarter, free cash flow came in at $3.9 billion. That brought the full year for 2019 to $2.3 billion, which exceeded GE's own estimates as well as that of analysts. And then the optimism today really coming in from the fact that going forward into 2020, they say that free cash flow will be up as much as $4 billion. That is well above what analysts were expecting, around $2.2 billion on average. So, of course, this is a positive story. The street looks pretty happy about it today because this may mean that GE can continue to pay down the debt, deal with its significant liabilities it has. And the CFO today actually said it could get the net debt to EBITDA ratio down to about 2.5 in 2020 from 4.2 right now.
And maybe what's even more impressive, they're working at some headwinds. They got some headwinds in aviation. They got some headwinds in power still
have those headwinds in power. I mean, this is a business that has been continually struggling, and in the fourth quarter, the power unit saw orders fall about 30%, and the free cash flow in that unit was negative $1.5 billion. You also saw weakness in the renewables unit, which saw orders down about 11%, but the strength in aviation actually outweighed that. They saw sales rise, they saw orders rise, $4.4 billion in cash flow in that business, despite the fact that they had a $1.4 billion headwind from the MAX. They're not getting paid for the engines they make for the Boeing 737 MAX as part of its joint venture. And despite that, the strength elsewhere in aviation was driving that business in the fourth quarter. Of course, there's a lot of uncertainty around the MAX going forward as we move on into the year, but GE is able to withstand that for right now.
Yeah, and in fairness, Larry Culp would say orders are not just orders. You want orders that will make you money.
Exactly.
And in the past, they've taken too many orders that just didn't make them money, and that was their problem. Okay, many thanks to Bloomberg's Kaylee Lyons. Coming up, we're going to speak with Neil Bradley. He's U.S. Chamber of Commerce Executive Vice President about the just signed USMCA trade agreement. This is Balance of Power on Bloomberg Television and on radio.
Have you ever thought, I wish I'd had that information sooner?
What does this tell us about the state of deal making?
Let's fix that.
One unprofitable company plus another doesn't make a profitable company.
Carol Mazur.
Talk to us about real-world applications.
Jason Kelly.
Remind us what the potential is for everyday folks.
Bloomberg Business Week.
Vice President of Exploratory Science is one of the cooler titles.
Weekday afternoons at 2 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg Business Week, now live on YouTube.
Imagine being fired because of who you love. Imagine being denied medical treatment because of who you marry. Imagine being evicted because of who you are. Millions of Americans don't have to imagine this. They have to live it. Because in 31 states, it's legal to discriminate against LGBT people. Get the facts at beyondido.org. Brought to you by the Gill Foundation and the Ad Council.
Vatsal Shah is Senior Project Engineer at Mott MacDonald, a global engineering consultancy with more than 16,000 employees. He earned his PhD at New Jersey Institute of Technology, and as an adjunct professor, is helping NJIT students explore emerging technologies.
My focus is renewable markets, emerging technologies, the idea of floating cities. What are we doing to develop that? What will happen to the city on the water? Well, you're going to have waves hitting it. You're going to have solar. How are you going to develop plants? How are you going to develop vegetation and farming? That sort of thought process happens at NJIT. We actually plan out what will the city look like. How do we develop that? So in 10 years, we're actually ready to take on those challenges when we have our first development in the water. NJIT also has been doing a lot of work in self-healing materials. So taking the polymers and the new material that we have in our material sciences departments and putting them into things like concrete, things like steel, reinforcing our soil.
NJIT, New Jersey Institute of Technology. Learn more at njit.edu.
The USMCA is the largest, fairest, most balanced, and modern trade agreement ever achieved. This is a colossal victory for our farmers, ranchers, energy workers, factory workers, and American workers in all 50 states.
That was President Trump speaking earlier today before signing the USMCA trade agreement into law. For more, we welcome now Neil Bradley. He's U.S. Chamber of Commerce Executive Vice President and Chief Policy Officer. He joins us from Washington. So, Neil, thank you so much for being here. This was a labor of love, but also was a hard labor. How'd you get it done in the end?
It was, and it's a tremendous victory, as the president just said, and it's really 3 years in the making. We had a lot of ups and downs and roller coasters and moments where we weren't certain we were going to get it done, but we knew we had to get it done. Remember, Mexico and Canada are America's two largest trading partners. 12 million American jobs hang in the balance when we talk about our trade with our neighbors to the north and our neighbors to the south. So failure was never an option. What we're particularly proud of is the way it ended. If you look at the votes that we had in the House of Representatives and the Senate teeing up the president's signature today, overwhelmingly bipartisan. And the great thing about that is not just that it locks in support for this important agreement going forward, having a majority of Republicans supporting it and a majority of Democrats, but frankly, that should be a precedent for all the other stuff that we need to get done, both in the trade arena and in elsewhere to help support our economy.
And we want to talk about that, but first, tell us about what differences it makes right now to the U.S. economy, to the U.S. businesses, to the members of the U.S. Chamber of Commerce.
Well, the first and most important thing is certainty, right? So these are important trading relationships. Supply chains go deep into Mexico, deep into Canada. There's a lot of concern about disrupting those supply chains and what that would mean for American workers. That disruption is now off the table. We know what the rules are. We have an agreement on the rules. This is going to provide a lot of certainty for business. But it also opens up new opportunities. Remember, NAFTA was signed before there was an internet. Now we think about all the work that's done in digital goods, the way that the internet allows small businesses to sell around the world, where it used to be they were confined to their neighborhood. Now they can sell globally. This agreement updates NAFTA so that it has, for the first time, a digital chapter that governs digital trade in goods. It has a small business chapter. There are about 120,000, by our estimate, small businesses who sell goods or services from the U.S. into Canada and Mexico. This provides them a framework that's going to make it easier for them to do what they're doing and to grow their small businesses.
Neil, we hear an awful lot about enforcement questions with so-called Phase 1 of the U.S.-China trade deal. What about enforcement with USMCA? I know there was some back and forth right there at the end involving autos and rules of origin with Mexico. What sort of enforcement challenges will this new treaty provide?
Well, the good news is like NAFTA before it, we have dispute resolution processes that are built in place into this agreement. And so the real virtue of getting an enacted trade agreement like we now have with USMCA is that when disputes arise, and they inevitably do, there's a process for working through those disputes. And so there was some concern expressed particularly by congressional Democrats about the process for enforcing some of the labor rules with respect to Mexico. Ambassador Lighthizer deserves a lot of credit for coming to an agreement with congressional Democrats on that. And so now we have locked in place a process for resolving those disputes. And that's what contributes to the certainty I was just talking about a moment ago.
Neil, you suggested a moment ago that maybe some of what happened with USMCA could serve as a template or at least a guide to future trade negotiations in the United States where there are a lot of issues. Give us a couple of things out of the USMCA that you think could be applicable elsewhere.
Well, so for example, the digital goods section, we would like to see that replicated. Same with the small business section. There's also some things that we shouldn't replicate. One of no deal is perfect, and that applies to this USMCA. One of the things we were disappointed in is we didn't achieve the protection for intellectual property, particularly in new and emerging medicines, so-called biologics, that we had hoped to achieve here. So we have a good foundation. We should build on it as we look to agreements, in particular with the UK, some agreement ultimately with the EU. We have to get back into Asia and work through trade agreements with Asia beyond just the mini deal that was already done with Japan. There's a lot more work to be done there. And to the administration's credit, we're beginning to look in other places around the world, including Africa, where we might be able to expand our trading relations.
So everybody's going to claim some credit here, as they should. That's fair. But to what extent would the TPP deserve some credit? That is that Trans-Pacific Partnership that didn't go anywhere. Doesn't USMCA borrow a fair amount for that?
It does borrow from it, and I'm glad you raised that because it's an important point. The Obama administration, for what they negotiated in TPP, and we worked very closely with them to ultimately reach the TPP agreement, was the stepping stone to begin modernizing some of these trade agreements. So we took some of the best elements from it.
Yeah, how ironic. Thank you so much to Neil Bradley. He's U.S. Chamber of Commerce Executive Vice President. And we're going to have more with Neil coming up in the 1 o'clock Eastern Time on Bloomberg Radio. Coming up here, we are just about 1 hour now away from the Fed decision. Bloomberg will have live coverage starting at 2 p.m. This is Bloomberg.
This is a Bloomberg Pursuits look at luxury. Whatever your views on climate change, nobody wants to hear this. A new study concludes rising temperatures will affect the wine industry, and not in a good way. According to the National Academy of Sciences, more than half of the areas around the world suitable for growing grapes used for wine could become unsuitable for that purpose in 80 years. Wine grapes are extremely sensitive to changes in temperature. Political protests in Hong Kong are showing up in luxury goods makers' earnings statements. LVMH, the sales growth slowed over the holiday quarter as protests in Hong Kong dented Chinese demand for the luxury giant's products. Global sales increased to less than forecast 8% and had been riding high during a 3-year boom led by Chinese customers. And LVMH isn't all. Italy's Salvatore Ferragamo also says it was hit by the turmoil in Hong Kong, with retail sales there falling more than 50% from a year earlier last quarter. Visit BloombergPursuits.com for more. I'm Andrew O'Day, Bloomberg Radio.
Financial leaders enjoy talking with Tom Keene and Jonathan Farrell.
What was it like having the giant darken the door every once in a while?
Experts appreciate it when what they have to say is understood.
Do you think that we might have seen a cyclical peak in the labor market?
It's the same reason we're recommending Bloomberg Surveillance to you.
Everything you thought would happen is happening.
Weekday mornings at 7 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Sweet strawberry icing. You're in Goodwill, and just past that vintage denim jacket you spot miniature donut earrings. You lean in. Ah, that's the scent of shopping success. Because at Goodwill, every item you buy funds local job training and more. So bring home those donut earrings and bring home so much good to your community. Goodwill. Bring good home. Brought to you by Goodwill and the Ad Council.
Rich is just a really good guy. The term good egg isn't enough to describe him. He's also certified organic and free range. Rich puts the cap back on everything. The toothpaste, the olive oil, the shampoo, everything. He lets his 10-year-old nephew beat him at virtual tennis, even though he can straight up slay his 10-year-old nephew in virtual tennis. When the toilet paper is running low, Rich replaces the roll on the actual holder, not just on the back of the toilet. Rich is texting and driving. Rich, no. What are you doing, Rich? I was just telling everyone how great you are. Texting and driving makes good people look bad. Visit StopTextStopWrecks.org. A public service announcement brought to you by the National Highway Traffic Safety Administration and the Ad Council.
From the financial capital of the world, 24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. It is an update for the Dow, the S&P, and the NASDAQ Composite Index. Stocks climbing after solid earnings from bellwethers overshadowed weak economic data and concern about the deadly coronavirus. Investors are awaiting the latest Federal Reserve decision.
And I think that Jay Powell today will mention probably that there are limits to monetary policy. How do you create demand for loans when interest rates are low? Well, you can't really do that from the monetary policy side. That has to come from the fiscal side, and you're not likely to see that at all during an election year.
Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence. We are under 1 hour away. Complete coverage here on Bloomberg Radio. And, of course, we will have the Powell press conference beginning at 2:30 p.m. Wall Street time right here on Bloomberg Radio. Lots coming up today. A busy day for earnings. Facebook, Tesla, Microsoft all after the closing bell. And at 3:30 Wall Street time, we'll be speaking with Goldman Sachs CEO David Solomon at the Goldman Investor Day. Apple shares jumping to a record after earnings, reporting holiday quarter revenue that beat Wall Street expectations on rebounding iPhone demand. Apple up 2.7%. Also after earnings, AMD down 7.1%. Starbucks down 2.9%. AT&T down 3%. But on the plus side today, General Electric surging by 10.4%. The Dow up 113 points, up 0.4%. S&P up 9, a gain of 0.3%. And NASDAQ up 28, that is a gain of 0.3%. 10-year up 11/32 yield 1.61%. Gold up 0.2%, 15.70 the ounce. West Texas Intermediate crude down 0.6%, 53.18 a barrel. Brent advancing 0.2%, now at 59.65. So again, recapping, stocks higher, S&P up 9, a gain of 0.3%. 102 on Wall Street. Time now for the Market Drivers Report with a focus on American depository receipts. Here he is, Dave Wilson.
Thanks, Charlie. ADRs have been left out of the gains among U.S. shares. The S&P ADR index is little changed, while the S&P 500 is up 0.3%. Spain's Banco Santander has gained 4.8% in U.S. trading. The lender's fourth quarter profit beat analysts' average estimate in a Bloomberg survey. Chairman Ana Botan said Santander expects annual earnings per share to rise by a high single-digit percentage over the next 3 years. Japan's Rakuten has risen 2.3%. CEO Hiroshi Mikutani tweeted that the online retailer will proceed with a plan to provide free shipping. Now, that offer is the target of an investigation by Japanese regulators who began the probe yesterday. Another Japanese company, Canon, has dropped 2.9%. The maker of printers, copiers, and cameras reported quarterly earnings and sales that missed estimates. Canon's operating forecast for the current fiscal year also came up short. And Dutch phone company KPN has fallen 5.6%. A cash flow forecast for this year missed estimates, according to Berenberg. KPN said the outlook reflects a capital spending shift toward fiber optic lines and away from information technology, Charlie.
All right, we thank you very much. Dave Wilson tracking those American depository receipts. Recapping, U.S. equities higher, the Dow, the S&P, and NASDAQ all gaining ahead of today's Fed decision. S&P up 9, a gain of 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
This is Balance of Power.
We have the strongest economy by far in the world.
We're going to grow our trade relationship.
I know what's broken. I know how to fix it.
Where the world of politics meets the world of business.
They've got the money they need to run a very competitive race.
We've got now a real crunch few days for Brexit.
We want certainty in the markets. We want certainty in our trading relationships.
The administration is trying to create a new divided world.
Balance of Power with David Weston on Bloomberg Radio.
The coronavirus continues to spread in China as the government and business struggle to keep up. President Trump's impeachment trial enters the question phase as Senator McConnell tries to get the votes to block subpoenaing witnesses. And the USMCA is now law, leaving the question whether we can come to terms with our other trading partners as well. From the Bloomberg Interactive Broker Studio, welcome to the second hour of Balance of Power. President Trump earlier today signed the USMCA, saying it wasn't easy, but somehow they got it done.
Everybody said this was a deal that could not be done. Too complicated, too big, couldn't be done. We got it done.
Well, the USMCA may be done, but there is a lot left on USTR Lighthizer platter with European trade, the next phase of the China trade deal, and WTO reform still pending. Neil Bradley, Executive Vice President of the U.S. Chamber of Commerce, is still with us. So, Neil, thanks for staying with us. And in the first hour of Balance of Power, you said there's some other things they need to get done. What's at the top of the list?
Well, certainly within the trade agenda, it's resolving the current conflict with China. You know, phase one of the agreement that the president signed earlier this year is only good if it helps us get to phase two, and if there's a phase three that's needed, a phase three that brings this to conclusion. So we're really looking forward for progress in 2020, in particular with our trading relationship with China. Ultimately, now that we're moving forward therefore with Brexit, we have to figure out the right trading regime with the UK. And also, we have conflicts with the EU. We had conflicts before we saw European countries adopting or attempting to adopt digital services taxes. So there's a lot of issues there that need the attention of Ambassador Lighthizer and the business community.
So you've seen a fair number of these complex government negotiations go on. As a practical matter, is anything with China essentially on hold until we figure out, and particularly the Chinese figure out, what's going on with the coronavirus?
Well, it certainly makes it difficult, and I think they're right, and we're right to prioritize this. I mean, this is a very serious threat. It deserves the attention, if not even more attention than what it's getting, and a lot of fear in terms of an inability to contain this virus. And so, no question that's going to divert attention away, appropriately so. But I'm also confident that as we continue to tackle the coronavirus, we can also get back to resolving these trade challenges.
You mentioned the United Kingdom. The European Parliament just voted to accept the deal under which the British will leave the European Union. It's timed for Friday, which is what Prime Minister Boris Johnson promised. How difficult is that deal between the United States and the UK? I mean, President Trump has certainly said we can get this done. It could be great. It could be big.
Well, there are definitely issues to be worked out, and there are issues that the UK obviously has to work out with the EU. So I don't want to undersell how difficult this is going to be. I think there are some complicated issues to work through, and it's going to take time, and they obviously have other issues on their plate. But it's also incredibly important. We've benefited from not just a long-standing trading relationship with the UK, but think about financial services, for example. And there's a tremendous opportunities both for U.S. companies and for the UK if we can come to an agreement. So no question a top-tier priority.
And what about Europe? It's something that President Trump particularly focused on over in Davos, Switzerland. Trade with Europe. We have a new regime from top to bottom, really, at the top of the European Union. And as I understand it, the President of the European Commission is on her way over to Washington. What are the hopes, expectations, fears?
Well, the fears is that we end up in some type of escalation and conflict, right? So that's why even though there's a lot of work to be done on digital services taxes, for example, not entering into kind of some new trade war where they impose taxes discriminatorily on U.S. companies, they being EU nations in this instance, and the U.S. is retaliating with tariffs, and we have this ever-going escalation between sides, is certainly something that we want to avoid. We've always had long-standing regulatory issues, in particular with the EU. I mean, this is something that the Obama administration was working on, that the Bush administration was working on before the Obama administration. So there's a lot of difficult things to work through. Hopefully we won't get distracted by other side issues. For example, a threat of automobile tariffs. That would be devastating, not just for the Europeans, it'd be devastating for the American economy. And so hopefully we can keep those issues to the side and focus on kind of what have been historical core challenges in our trading relationship.
Neil, you're very much involved in trade for the U.S. Chamber of Commerce, but that's not all of your brief by a long shot. Talk to us in general about the agenda before Congress and whether there are any hopes anything else could get done this year. In the first hour balance bar, we talked with a couple of congressmen who said maybe infrastructure, maybe something in the highway bill. Are there hopes for that?
There are. So a little bit of news that's probably been overshadowed today by other events is House Democrats unveiling their outline for an infrastructure plan and House Republicans unveiling an outline for where they would like to see it go. While we're far from a bipartisan agreement in the House, getting those plans and those outlines out there is the basis of how we begin to come to an agreement. Let's remember USMCA, which we're celebrating today. For the longest period of time, we had stark disagreements between congressional Republicans and congressional Democrats. And one of the things that we're proud of in terms of our work at the U.S. Chamber is trying to bridge those differences and encouraging each side to figure out how they could come to an agreement. We see the same opportunity when it comes to infrastructure. If we can get that going in the House and marry that up with a bipartisan bill that we already have in the Senate, I think there's every reason for incumbent Republicans, incumbent Democrats, and the president to want to get an infrastructure bill done before we get to the fall campaign.
Just in the few moments we have left here, Neil, we hear from Republicans and Democrats they want infrastructure. Is the real issue how we pay for it?
It is, and it's been a long-standing issue. We have a solution at the U.S. Chamber. We haven't adjusted the federal fuels tax for inflation or mileage since 1993. We've been forcing states to do it on our behalf in modest incremental steps. If we did that, we could take care of roads, bridges, and transit. Right. And we actually think there's a lot of capital out there on the private sector side that we could bring to bear for the rest of infrastructure.
Well, there's a hopeful note. Thank you so much. Really appreciate it. It's Neil Bradley of the U.S. Chamber of Commerce. Coming up here, the whole world is watching the coronavirus in China as governments and businesses scramble to react. We talk with healthcare policy expert Chris Meekins of Raymond James. That's next on Balance of Power on Bloomberg Radio.
If you promise to cover the latest financial and business news from Asia,
we're talking about social enterprises in Asian countries
with expert analysts who really understand Asia.
Aren't you encouraged with respect to U.S.-China trade?
Then you must be us.
Tell us about the trend within this part of the world.
Bloomberg Daybreak Asia.
What sort of fiscal stimulus do you think we'll see?
Tonight at 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Adopt US Kids presents What to Expect When You're Expecting a Teenager. Learning the lingo.
GOAT, G-O-A-T, acronym, stands for Greatest of All Time. As in, spaghetti sandwiches for dinner? They're my fave. Dad, you're the GOAT.
You don't have to speak teen to be a perfect parent. Thousands of teens in foster care will love you just the same. Visit adoptuskids.org. Brought to you by the U.S. Department of Health and Human Services, Adopt U.S. Kids, and the Ad Council.
What if you could keep the top economic experts in a conference room next to your office without having to feed them?
Do we need better optics? Do we need some substance? Do CEOs care about ESG?
We have seen quite a lot of stimulus pumped into the system already.
It's the biggest warning yet about the financial risks of climate change.
Now there are more ways to hear us. Bloomberg Radio, the Bloomberg Business, Radio.com, and iHeartRadio apps, and at BloombergRadio.com. Bloomberg, the world is listening.
Hi, I'm Danica Patrick. Watching my nieces grow, play, and learn is amazing, but not every child gets to be carefree. 1 in 6 kids in the U.S. are hungry. This breaks my heart, and it's something that Feeding America is working to change. Each year, the Feeding America network of food banks rescues billions of pounds of good food that would have gone to waste and gives it to families in need. To help, visit feedingamerica.org.
Brought to you by Feeding America and the Ad Council.
Are you interested?
Boredom, fitness enemy number 1. So don't just run. Run, run, mix it up, skip, run, skip, run. Give yourself a lift, mix it up, lift, mix it up, run, lift, splash, skip, lift, run. It's crunch time, skip, mix it up, run, mix it out of boxing class. Skip, run, splash, skip, run. Mix it up at Virgin Active and get stronger, fitter, faster. Join now for 12 months and pay nothing until March. T's and C's apply. Run. Mix it up. Mix it. Run. Mix it.
Hey, have you heard? The Mayor of London has launched his latest van scrappage scheme to help tackle London's toxic air. Small businesses or sole traders like me with a polluting van could now get £7,000, which you could use to trade up to a Euro 6 vehicle. And you could get an extra £2,500 towards running costs if you go electric. The scheme is now even easier to qualify for, and it's open to any businesses with up to 50 employees, like mine. So, I'm going to search TfL Scrappage to see if I'm eligible and apply. You should do the same. To the Mayor of London and TfL, every journey matters.
Right now, instead of hearing this, you could be listening to the music that keeps you moving with TuneIn Premium. Find today's biggest songs and all of your favorites commercial-free. Visit TuneIn.com/premium to upgrade.
You might already know that TuneIn allows you to listen to all the pro sports leagues wherever you go. But did you know TuneIn is also home to the wide world of college sports?
Open 3, DeAndre Hunter got it! Handoff Carruthers, big hole right side. He leaps and he surges in, touchdown!
From live college football, basketball, and baseball games to podcasts and coaches shows fueling your love for the game in your school. And the best part is, it's all free. Search college sports to find your team or league.
TuneIn remembers the life, the success, the legacy of Kobe Bryant.
Buckle up for Kobe Bryant!
Five-time NBA champion.
It was my dream to be a Los Angeles Laker.
The Lakers repeat back-to-back titles.
Devoted husband and proud father of 4 daughters.
I love having girls. They're awesome, man.
People are in disbelief that this global and cultural icon could be gone.
Search Remembering Kobe Bryant on TuneIn for podcasts and interviews of the legend, Kobe Bryant.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you.
This week on the New Yorker Radio Hour, taking the long view on prison.
In 100 years, we're not going to be locking human beings in cages. Because we'll understand then, as we understand about slavery now, that it was immoral, that it just didn't work.
Listen to this episode of the New Yorker Radio Hour on TuneIn today.
24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pelletier, developing stories. 2 headlines from the Bloomberg Professional Service. Lyft plans to announce a restructuring and job cuts today. This according to a report in the New York Times. Lyft shares on an update for the rest of the market down now by 1.1%. And Iberia out of Spain suspending flights to Shanghai due to the coronavirus. Iberia becoming the latest airline to either halt or scale back service to China. The Dow, the S&P, and NASDAQ all advancing after solid earnings from bellwethers, overshadowed weak economic data, and concern over the deadly coronavirus. Apple, for example, at a record up 2.6%, now at $325.95. The Dow up 127 points, up 0.4%. S&P up 10, up 0.3, and NASDAQ up 32. That is a gain of 0.4%. 10-year up 12.30 seconds, yield 1.61%. Gold up 0.2%. 15.70 the ounce. Sam West Texas Intermediate crude down 0.5%. 53.22 a barrel. Recapping, stocks higher. S&P up 11, a gain of 0.3%. I'm Charlie Pellett. That's a Bloomberg Business Flash.
Thanks so much, Charlie Pellett. From the Interactive Broker Studio, this is Balance of Power on Bloomberg Radio. The coronavirus in China continues to expand exponentially, with the number of reported cases already past those in the SARS epidemic, reaching in 2 months what it took SARS 9 months to accomplish. And health officials both in China and around the world are rushing to come up with the most effective response. HHS Secretary Alex Azar said yesterday that, at least so far, it's not a serious threat to Americans.
Americans should know that this is a potentially very serious public health threat. But at this point, Americans should not worry for their own safety.
We welcome now Chris Meekins. He's Raymond James Vice President and Healthcare Policy Research Analyst. Before coming to Raymond James, Mr. Meekins had extensive experience in healthcare on Capitol Hill and at the Department of Health and Human Services. So, Chris, thank you so much for joining us today. Is Mr. Azar, at least so far, right? This is not really a real threat to American safety.
Yeah, thanks for having me, David. I think from my perspective, people are anticipating what the impact would be in the United States and under anticipating how bad it's going to be in China. So I think the secretary is correct. And the secretary who had experience and was at HHS during the SARS epidemic and was at HHS during the anthrax attacks is someone who really is an expert in these potential public health emergencies and emerging infectious diseases. And I think he's right that in the U.S., people really don't need to worry at this point. I think we'll see some additional cases in the U.S., but the number of cases in China is going to continue to grow. And as you said, really we've seen a kind of a remarkable shift in that in just 2 months compared to SARS that took 9.
Well, and so do we have any experience in the past, SARS or other epidemics, about the pattern here? Because it seems right now, as I said, I think it's growing geometrically, not arithmetically.
Yeah, I think that we've seen this type of an impact in other infectious diseases, whether it's pandemic influenzas or SARS. I think it's important to put a massive caveat and asterisk next to the SARS numbers, because what we know is that China did not have the same level of public health surveillance that they have today. They've made pretty dramatic improvements since the SARS epidemic. So the SARS number was probably also significantly more than what was reported at this point. So from my perspective, you're going to continue to see increases. The fact that China has basically sequestered 56 million people is really noteworthy, and has said not just that employers shouldn't bring people back to work till December 10th. You now have them going to December 13th at least, and I think that probably stretches out another week or two.
Talk about some of the things that, as you say, the Chinese government has been doing, and by the way, the United States and other governments are doing to some extent. Are they efficacious? Is shutting down airplane flights, is that going to work? Is the lockdown going to work? Does that work, or is that more to show the public we're doing something?
I think there are mixed results. I mean, anytime you lock a large group of people in a confined space, there increases likelihood that they could get infected. And then there are the moral and ethical concerns about if you know a disease is spreading in an area, your refusal to allow people to leave, whether that's morally and ethically right. I think from a health perspective, there's no question that if they had failed to shut down the travel in a meaningful way, you probably would have seen a pretty notable increase in cases in other parts of China as well as around the world. I think the fact that additional airlines like British Airways and Lufthansa now saying they're not going to have direct flights to China for a period of time is probably wise to prevent the spread to other nations.
At this point, it feels like we know some things. There's a lot we don't know as well. The Chinese were pretty quick to identify exactly the DNA structure of the virus, and they shared that, as I understand, around the world. At the same time, do we know, for example, whether you can have asymptomatic transmission? Because some doctors have said that's rather important.
It is rather important, and there's conflicting information, mainly because while China has shared the initial strain of the virus, more recent strains, there's a question of whether or not they've shared the genetic information on that. And Chinese officials are saying it can be shared while people are asymptomatic, but the Centers for Disease Control has not been provided that data from China. And Dr. Redfield down there is exactly correct. We don't base our scientific findings on what other people claim. We need to get the data and review it ourselves so that we know what's true. I believe that it is able to spread when people are asymptomatic, because China really has no incentive to claim that it can when it really can't.
In the meantime, there's a lot of talk about vaccine. Everybody immediately says, let's develop a vaccine. As I understand it, there still isn't a vaccine for SARS, is there?
I haven't heard of one, and I think it's important to remember with vaccine development, you're talking at least a year away.
Yeah, exactly.
And probably longer. And I always get incredibly nervous when I see all these small vaccine companies say, we'll develop a vaccine, we'll develop a vaccine. People throw their money into those names, and then no vaccine comes. Remember that the Ebola outbreak happened many, many years ago, when we're just now getting a vaccine that can be used for it. Developing vaccines is difficult. So my perspective, when I'm looking at different companies and investments, my advice is to say, if the government is putting up money with a company to develop a vaccine, those are companies that are viewed as credible and people should consider investing in. If a company is not getting a government investment in that, because there really isn't a commercial market right now for this, then I'd be really skeptical of what the companies are claiming.
It's really wise advice. Thank you so much, Chris. Appreciate your being with us. That's Chris Meekins of Raymond James. Coming up here, Majority Leader Mitch McConnell's red wall protecting against calling witnesses in the Senate just may be crumbling. Could testimony make a difference in the impeachment trial of President Trump? And will they, in fact, call witnesses? And if so, which witnesses will they call? We talk with Professor Frank Bowman of the University of Missouri Law School. That's coming up next on Balance of Power, and we are on Bloomberg Radio.
This is a Bloomberg Money Minute. Wall Street is in the green after Apple sold more iPhones and wearable devices in the fourth quarter. And online ordering, kiosks, and more breakfast menu items boosted sales at McDonald's by 5% last quarter. The Dow was up 109 points, S&P up 8, the NASDAQ up 25. $18 billion and counting. That's how much Boeing says the grounding of its troubled 737 MAX jet will cost the company after posting its first annual loss in 2 decades. Victoria's Secret could soon be up for sale. The Wall Street Journal reports L Brands is exploring options for the lingerie chain, which could mean a full or partial sale. And Generation Z, those Americans born in the mid-1990s, are now racking up a lot of credit card debt. TransUnion says a typical 24-year-old owed $2,000 on a credit card last year. Donna Wilson, Bloomberg Radio.
Hey, it's me, your cell phone. We need to talk about something serious. I know you love me. I know you like using me wherever you are, but I feel like this isn't working out when you're driving. I know you may think that it's possible to focus both on me and the road, but I just don't feel the same way. I think we should spend time away from each other when you're driving. It's for the best.
Visit StopTextStopWrecks.org. A message brought to you by the National Highway Traffic Safety Administration, Project Yellow Light, and the Ad Council.
The market's in focus every business day. The P&L Podcast with Paul Sweeney and Lisa Abramowitz.
Are there some sectors that you want to have more or less exposure to?
What's behind this engine of gains?
Analysis of the day's Wall Street action.
The U.S. market looks relatively safe.
From Bloomberg Intelligence, Bloomberg Opinion, and influential newsmakers.
Ward McCarthy joins us right now.
P&L with Paul Sweeney and Lisa Abramowitz. Listen today on Bloomberg.com, the Bloomberg Business app, or subscribe on Apple Podcasts. Are you interested?
Boredom, fitness enemy number one. So don't just run. Run, run. Mix it up, skip, run, skip, run. Give yourself a lift. Mix it up, lift. Mix it up, run, lift, splash, skip, lift, run. It's crunch time. Skip, mix it up, run. Mix it out of boxing class. Skip, run, splash, skip, run. Mix it up at Virgin Active and get stronger, fitter, faster. Join now for 12 months and pay nothing until March. T's and C's apply. Run. Mix it up. Mix it. Run. Mix it.
Hello, I'm your captain for today's Virgin Atlantic flight. Please drop everything and pay close attention to the following announcement. The sail is now on. Our crew are ready to take your bags and stresses away. The cocktails are ready to serve, the movies are loaded, and we're all set for takeoff to the Caribbean. So, take your seat in our award-winning economy class. We're ready to go when you are.
The Virgin Atlantic sail. Fly amazing for less. For more details, visit virginatlantic.com.
You might already know that TuneIn allows you to listen to all the pro sports leagues wherever you go. But did you know TuneIn is also home to the wide world of college sports?
Open three, DeAndre Hunter got it! Hand off Carruthers, big hole right side. He leaps and he surges in, touchdown!
From live college football, basketball, and baseball games to podcasts and coaches shows fueling your love for the game in your school. And the best part is, it's all free. Search college sports to find your team or league.
TuneIn remembers the life, the success, the legacy of Kobe Bryant.
Buckle up for Kobe!
5-time NBA champion.
It was my dream to be a Los Angeles Laker.
Repeat, back-to-back titles.
Devoted husband and proud father of 4 daughters.
I love having girls. They're awesome, man.
People are in disbelief that this global and cultural icon could be gone.
Search Remembering Kobe Bryant on TuneIn for podcasts and interviews of the legend, Kobe Bryant.
Did you know your favorite radio stations are in your pocket? Yes, the TuneIn app lets you listen to the same radio stations you pick up on your home or car radio anywhere you want. To see all the stations broadcasting in your area, find the local radio section on the home screen. Keep it local with TuneIn.
This is not a commercial. This is a reminder. With TuneIn Premium, you could be listening to more music commercial-free. Get over 45 commercial-free music stations. Visit TuneIn.com/premium to upgrade.
I think I just be myself, let it come naturally. I never try to, go outside the box.
Super Bowl 54, the biggest game of the year, is live on TuneIn Premium. Be there when the Kansas City Chiefs, dreaming of their first championship in 50 years, collide with the San Francisco 49ers' quest to bring a 6th Lombardi trophy to the Bay Area. Wherever you are when the ball kicks off Sunday at 6:30 p.m. Eastern, listen to every electric moment of Super Bowl 54 with the NFL on TuneIn Premium. Search Premium to upgrade today.
This week on the New Yorker Radio Hour, taking the long view on prison.
in 100 years, we're not going to be locking human beings in cages, because we'll understand then, as we understand about slavery now, that it was immoral, that it just didn't work.
Listen to this episode of the New Yorker Radio Hour on TuneIn today.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Balance of Power with David Weston.
Coming up on Balance of Power, we may just get witnesses after all in President Trump's impeachment trial in the Senate. We're joined by my colleague June Grasso to talk about the likelihood and the implications. But first, let's get a market check with Charlie Pella.
Hi, thank you very much, David Weston. A happy Wednesday, indeed, Fed Wednesday. 29 minutes to go until we get that Fed decision. We'll have it for you live here on Bloomberg Radio, complete with reaction and analysis, the kind of world-class analysis you've come to expect over the years from Bloomberg Radio. And, of course, at 2:30 p.m. Wall Street time, yes, we will have Jay Powell for you live on Bloomberg Radio and Bloomberg Television. Number of headlines to pass along to you from the Bloomberg Professional Service. First of all, the Algerian energy minister says the OPEC March meeting may be moved to February. Iberia planning to suspend flights to Shanghai because of the coronavirus. And the New York Times says Lyft will be announcing a restructuring along with job cuts today. Lyft shares moving lower, down by 1.3%. Stocks climbing after solid earnings from bellwethers overshadowing weak economic data and concern over the deadly coronavirus. As investors await the Fed decision, strong results from Apple and GE pushing equities higher. General Electric surging now by 10%. Apple at a record up 2.8% at $326.75. There is more evidence the rebound in America's housing market could be leveling off even with low mortgage rates and a healthy labor market. And with more on that story, here's Bloomberg's Vinny Del Giudice.
Contracts to buy previously owned homes posted the largest decline in almost a decade in December. Economists had anticipated a gain. Fewer homes have been coming on the market, sending prices higher. The figures from the National Association of Realtors follow government data showing new home sales dropped to a 5-month low. Vinny Del Giudice, Bloomberg Radio.
Facebook, Tesla, Microsoft, all after the closing bell. 3:30 Wall Street time. We will be speaking with Goldman Sachs CEO David Solomon at the Goldman Investor Day. You'll catch that live on Bloomberg Radio and television. 10-year up 12/30 seconds. Yield 1.61%. West Texas Intermediate crude down 0.5%. 53.23 a barrel. Brent crude up 0.3%. 59.70. Gold up 0.2%. Again, the 10-year up 12/30 seconds. Yield 1.61%. Recapping on equities, stocks higher across the board. Nasdaq up 0.5%. The Dow up 0.6. S&P up by 0.4. I'm Charlie Pellet. That's a Bloomberg Business Flash. Balance of Power continues again, the Wednesday edition, and here he is, David Weston.
Thank you so much, Charlie Pellet. Majority Leader Mitch McConnell reportedly told his Republican caucus yesterday that he didn't have the votes at this point to avoid calling witnesses in the impeachment trial of President Trump. And for their part, some Republicans say that if any witnesses should be called, they should include Vice President Biden's son, Hunter, something Minority Leader Chuck Schumer says would make the trial a circus.
Republicans could call Hunter Biden today. They have the votes. Trump and McConnell could call for Hunter Biden today. They don't want to. They know it would turn things into a circus.
We welcome now my colleague June Grasso and Professor Frank Bowman of the University of Missouri Law School. Professor Bowman is the author of High Crimes and Misdemeanors, A History of Impeachment for the Age of Trump. So, Professor, as a law professor, is there any reason not to call witnesses at this point? Why don't you just call the witnesses, hear what they have to say? They can take it into account or not?
I think that would certainly be preferable. As has now been pretty copiously reported, there's never been not only a presidential impeachment trial, but any impeachment trial at all that did not include at least some witnesses in the Senate trial phase. So I think it's entirely appropriate that witnesses be called, and obviously there is a particular need from the point of view of the House managers, in a situation where part of the president's defense is, well, Guile, you can't prove that that I actually told somebody to extort Ukraine by withholding aid, and then at the same time is preventing the people to whom he may have said that from testifying. And that's made even more acute by the fact that we now have Ambassador Bolton, whose book suggests that he did hear exactly such a statement. On the other side, I think Minority Leader Schumer makes a very good point. If the Republicans want to call witnesses, they've got the votes, because the thing to understand about this whole proceeding is that even though we have Chief Justice Roberts in the chair, functionally he has very little power at all. If a majority of the Senate wants to hear from lots of witnesses or just one, all they have to do is vote for it.
So, Professor Bowman, let me invoke another law professor, at least a law professor emeritus, who's now representing President Trump, Alan Dershowitz. And Alan Dershowitz, as I understand, his position is, I don't care what John Bolton says, because even if the president did say, yes, absolutely, I'm withholding this aid to Ukraine because I want them to investigate my political rival, that would not constitute an impeachable offense for which the president be convicted, because it's not a crime, and a lot of presidents do things like that.
Well, Alan stands alone in the entire American Academy, essentially. There is essentially no support at all for the view that high crimes and misdemeanors requires proof of a crime or even crime-like behavior. Think about the implications of what Alan is arguing. And he, as much as he in fact gave this ridiculous hypothetical himself in his own book that he wrote in 30 days. He said, well, suppose the President of the United States were to conclude that Russia really had a better claim to Alaska than we do, since after all we got it from Russia in the first instance, and so we're just going to give Alaska back to the Russians. Now, that wouldn't be a crime, but according to Alan, that wouldn't be an impeachable offense either, because it's not a crime. One can go through an entire litany of situations in which a president engages in all sorts of horrible behavior, horribly damaging to American interests. That isn't a crime, but which nonetheless would be the sort of thing for which we certainly would have to remove him. This argument is actually raised in the impeachment trial of Andrew Johnson. One of the impeachment managers in the Johnson trial, Ben Butler, rose and said, well, and in response to the same argument, one of the things about the argument that Alan is making is it is what I characterized in an article I wrote a couple days ago as constitutional crabgrass. It comes up in every impeachment because the defendants always raise it, and it always has to be eradicated. But Ben Butler says in the trial of Andrew Johnson, suppose that in 1861, when the southern states got together and seceded, that we had as a president, rather than Abraham Lincoln, a man determined to preserve their union, we had a president who for whatever reason, a genuine constitutional reluctance, cowardice, some element of personal interest or corruption, that president simply didn't believe that he should or could act to save the union. Butler asks rhetorically, can it really be true that we have no remedy against such a person, that we are essentially required to let the country fall into two because we have a president who refuses to uphold the Constitution and the Union itself because it's not a crime?
Professor,
that's Helen's basic position.
Professor, let me ask you a question about John Bolton. If John Bolton is called to testify, let's suppose that, according to some reporting, the White House has sent a letter saying that what he has said in his book is classified. And, of course, the president has the authority to classify things. Would that stop him from testifying?
No, it certainly shouldn't. Understand what we're dealing with here. We are dealing with one of the fundamental interbranch checks on presidential wrongdoing, tendency towards presidential autocracy, and that is the check of impeachment. What the president is essentially saying is, look, if I do something in the field of national security, the area in which perhaps is most important to the future of the country. And there's evidence that I, in fact, did an impeachable thing, that I betrayed the interests of my country to foreign powers. I can prevent the Senate from hearing about that by simply waving the flag of national security is classified. No, you can't. No, you can't. Not in any country that purports to remain a democratic republic.
And subject to the rule of law. Okay, thank you so much to my colleague June Grasso and to law professor Frank Bowman of the University of Missouri. Coming up here, we're going to set the stage for the latest Fed rate decision. That's coming out just minutes from now at the top of the hour. What should we expect? What should we not expect? That's coming up next on Balance of Power on Bloomberg Radio.
Hey y'all, Jeff Foxworthy here. Now, if you've ever found yourself repeating the same thing over and over for 75 years, you might be Smokey Bear.
Only you can prevent wildfires.
That's why I'm filling in for Smokey to switch things up, because there's a lot more to say. And I should know because my grandfather was a firefighter. And one of the things he taught me is that the people that love the outdoors the most are often the ones accidentally starting wildfires, which means always BYOB. No, bring your own bucket to the campfire. And be extra careful with things like burning yard trimmings. Don't just walk away, or chances are you might be starting a wildfire. So for the love of the outdoors, go to SmokeyBear.com to learn more about wildfire prevention. Brought to you by the U.S. Forest Service, your state forester, and the Ad Council.
Why has J.D. Power ranked Commonwealth Financial Network #1 in independent advisor satisfaction among financial investment firms for the 6th straight time? We think it comes down to one thing: you. Because it's your input and feedback that keeps us focused on what's most important to you and your clients and continually pushes us to be the best we can be. Maybe that's why we receive top marks in every category of the J.D. Power 2019 Advisor Satisfaction Survey. They named us #1 in client support, #1 in firm leadership, #1 in operational support, #1 in compensation, #1 in professional development support, and #1 in technology support. Ready to partner with the best? Call Commonwealth at 866-462-3638 or visit commonwealth.com and feel the power. Member FINRA SIPC, a registered investment advisor. For 2019 J.D. Power Award information, visit jdpower.com/awards.
In-depth analysis.
Whatever job you're searching for, you can find it on LinkedIn. First jobs, flexible jobs, keep me out the cold jobs, advertising jobs, accounting jobs, HR, PR, even ER jobs, East London jobs, West London jobs, extra hour in bed jobs, startup jobs, late start jobs, get home in the daylight jobs, banking jobs, building jobs, flexible working on a Friday jobs, or even voiceover jobs, which is how I ended up recording this ad. Search millions of jobs on LinkedIn and find one meant for you.
I used to be a bit of a rubbish sleeper. I'd toss and turn all night, and somehow I could never find the comfy bit of the mattress. It was a proper nightmare. That's what brought me here, testing mattresses in the Which Test Lab. We use a custom-made barrel rolling machine to simulate a decade's worth of use. And the mattresses that perform best are the only ones we recommend for your bedroom.
Which tests harder so you can buy smarter. Visit which.co.uk.
Keys. Check. Phone. Check. 70s playlist downloaded. Check. Nice. There's one more thing you should check before you leave. Your travel. There's a new cycleway under construction between Kensington Olympia and Brentford Town Centre, so expect delays due to lane closures at the junction of Kew Bridge Road and Chiswick High Road. Plan ahead at tfl.gov.uk. To the Mayor of London and TfL, every journey matters.
Some ideas can be bad for business, like a band recording a song underwater. No radio station would ever play that song. Or like Barclaycard, making a repayment calculator that shows how a small extra repayment each month adds up to paying them much less in interest. But Barclaycard have actually made their repayment calculator, so you should definitely use it. Take control. Start today. Barclaycard. Terms and conditions apply.
Are you curious what others are listening to on TuneIn? Head to the trending section under Browse to see the most popular stations and podcasts among TuneIn listeners right now. Check it out. You might just discover something new for yourself.
Start hearing more of what you want. Upgrade to TuneIn Premium and get over 45 commercial-free music stations, live commercial-free news, and every live NFL, MLB, NBA, and NHL game. Visit TuneIn.com/premium to upgrade.
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
Go courtside with the NBA on TuneIn. With the NBA on TuneIn, hear your favorite team and players take on their biggest rivals during the biggest games throughout the year, including regular season showdowns, the 2020 All-Star Game, and the NBA Finals in June, featuring the home and away calls for all 30 teams. Plus, with the NBA on demand, relive the best moments of the season by listening to the past games in their entirety. Listen to the NBA all season long on TuneIn. TuneIn remembers the life, the success, the legacy of Kobe Bryant. Buckle up for Kobe! 5-time NBA champion.
It was my dream to be a Los Angeles Laker.
The Lakers repeat back-to-back titles. Devoted husband and proud father of 4 daughters.
I love having girls. They're awesome, man.
People are in disbelief that this global and cultural icon could be gone.
Search Remembering Kobe Bryant on TuneIn for podcasts and interviews of the legend, Kobe Bryant.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and on Quick Take by Bloomberg. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks are advancing. We are 13 minutes away from the latest Fed decision. Also, a lot of earnings after the bell today, including Facebook, Microsoft, and Tesla. Shares right now of Microsoft pushing higher by 1.7%, Facebook up 2.2%, and Tesla pushing higher by 2.2%. After last night's earnings, Apple at a record up 2.8%, Advanced Micro Devices down 7.2%, Starbucks down 2.2%. A lot of earnings this morning. Among the standouts, General Electric surging now by 10.1%. Bottom line, stocks advancing again after solid earnings from bellwethers overshadowed weak economic data and concern over the deadly coronavirus. S&P up 12, a gain of 0.4%. The Dow up 152, up 0.5. Nasdaq up 39. That is a gain of 0.4%. The 10-year up 12/30 seconds with a yield of 1.61%. Gold up 0.2%, 15.70 the ounce. And West Texas Intermediate crude oil up right now, down I should say, by 0.6%. WTI lower by 31 cents a barrel. West Texas now at 51.17. Recapping, stocks higher. Fed Wednesday, S&P up 12, a gain there of 0.4%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Live from the Interactive Brokers Studio, this is Balance of Power. I am David Weston. The Federal Reserve is due to render its first rate decision of the new year just minutes from right now at the top of the hour. Here to set up what we're likely to hear, and for that matter, what we're not likely to hear, is Yelena Shevtsova of Bloomberg Economics. So, Yelena, thank you so much for joining us. What are you expecting? What is it like about 11 minutes from now?
So nothing much 11 minutes from now, but probably at the press conference, we'll learn a little bit about Fed plans in terms of the balance sheet. Maybe we'll get a hint at what they're going to do, or if Chair Powell tells us a little bit about the economic impact from the virus, at least from the Fed's perspective. So that would be interesting to hear. So, but at the press conference, and before the press conference, I think no change in interest rates and very minimal changes to the statement. The most pressing change in the statement is the characterization of household spending, which is not strong anymore. It has actually moderated, and we will get a confirmation of that in the GDP report that is coming out tomorrow.
So if that continued, and it's too soon to say, that would point in the direction of a cut at some point down the road.
Well, the markets are expecting a rate cut.
Well, let's talk about that. I put up WIRP. You and I just talked about this, and if you look out to the end of the year, the likelihood it's like over 76%.
but the Fed is not telling us that they are expecting a rate cut. So there is a disconnect, which is not unusual. And I think the Fed is just being very careful, and they do not want to set market expectations at this point. So obviously there are downside risks right now to the outlook stemming from Boeing production hold, and that will weigh on economic growth in the first half of the year, as well as uncertainty surrounding the virus outbreak that potentially could impact growth to some degree this year. So, but we should not forget about positive developments. So the trade deal was signed, so that will boost business sentiment, and it's already kind of like warming up, I think. And another thing is the Fed cut rates 3 times last year. So don't forget about that. So the impact of that we will probably see sometime this year. So
before we look forward, let's go look backward. You mentioned the GDP number that's coming out tomorrow, the first read in the GDP. What are you and Bloomberg Economics expecting, and what does it mean for the year overall?
So we are slightly below consensus. We're expecting 1.7% growth in the final quarter of last year. So it doesn't mean that growth is slowing down to a critical degree so that it will require help from the Fed.
But it's a pretty steep curve. Where were you where was GDP in the first quarter?
So it was much stronger, and it really
it's a pretty steep curve down to 1.7.
Remember, the beginning of the year was affected by the government shutdown at the end of 18. So it's not quite correct to look at it and compare. It's not apples to apples. But nonetheless, growth is slowing, and I think that is pretty evident in the data. So the question is, to what degree it will slow down, and to what degree the slowdown will continue into this year. So we will get some data in GDP, and we'll see whether it's a permanent slowdown or whether it's more of a temporary factor impacted slowdown.
So you mentioned the China coronavirus, which is the talk certainly of the markets, certainly of Bloomberg today. I'm sure that we're going to hear the chair asked about that. At the same time, he presumably is not a biochemist. He can't quite tell us what's going to happen with a virus over in Wuhan. Is he just going to have to be very vague and say, we just don't know? I mean, is the Fed modeling this? Yeah. Are they modeling if this lasts a certain amount of time?
So the two channels through which this could impact growth in the U.S. is these are sentiment channel, and basically the impact on financial markets, and eventually the impact on consumer sentiment and so on, and perhaps a channel through the tourism and travel sector of the economy, which is small, but it could still be a measurable impact in the order of 0.1 to 0.2 of a percentage point. So I think Chair Powell will just say we'll be monitoring the situation as they always do, and at this point he will say there's not not much of an impact they're expecting.
So as we get ready, we're just a few moments away now from the Fed decision. You mentioned balance sheet. Mm-hmm. They basically started really injecting liquidity in the marketplace because of that overnight problem. If they withdraw it, is that going to be essentially like a rate hike?
No. So I truly believe that this will not impact the markets. And there was a great piece by Bill Dudley, the former New York Fed president, today on the Bloomberg terminal, where he basically argues that the rally in stocks is really due to a better economic outlook, and because of what the Fed did last year, that they cut rates 3 times. So, and it's not because of what the Fed is doing in the short portion of the yield curve. So I truly believe that is the right thing. They are not impacting, they're not messing up with the long portion of the yield curve. And it's not a QE. So if they wind that down and properly explain it, including at today's press conference, I think that should be fine.
Yelena Shelyatova of Bloomberg Economics. Yelena, thank you so much for being with us. And now it's time to go from cloudy, cold New York down to sunny Miami. And Jason Kelly and Carol Massar, who've gone down there because that's the only place you can really cover the Fed properly. Right, guys?
Yeah.
I know. It's a really tough assignment, David, but here we are doing what we can for the Bloomberg empire. And it is going to be fun. We're going to do the Fed decision, but we're going to visit with some Super Bowl winners a little bit later on in the show today.
Got a coach, a former winner of the big game.
Joe Theismann, you heard of him, I'm sure,
wow,
David
yes.
Weston from back in the day.
I remember that Monday Night Football game where he lost
last year,
his career.
Oh.
Remember that?
Yeah, so does he.
We talked about it
We talked about it with him last year, and
brutal.
he had some big takes on CBD last year and crypto. Yeah, so he is a very astute investor, so we're going to catch up with him.
Brian Billick, too, also a coach who won the big game, so he'll be here too, David.
Boy, it sounds pretty exciting for you guys down there. But you are going to cover the Fed, right? We're going to cover that too?
We are going to cover the Fed.
Oh, good.
So really, the first half of the show, we're going to be doing some Fed stuff. I know you're relieved about that.
We'll take the press conference, see what Mr. Powell has to say about the outlook, see what he says about the virus, too, right?
Yeah, exactly. So a lot of big questions. And but I tell you, though, David, I know you know Roger Goodell well.
I do.
No sign of a diminishing NFL here in Miami. It is bumping.
And by the way, that's a good point. A couple of years ago, people were saying the NFL had their day. They were on their way down. Boy, they've come roaring back. So I'm really envious, as you can probably tell, but I'm glad you're down there. Have a great time. That does it today for Bloomberg Balance of Power. Right now, we're going to get Bloomberg Business Week. The best of Bloomberg Business Week coming up with Jason Kelly and Carol Masser.
Bloomberg Day.
Keys. Check. Phone. Check. 70s playlist downloaded? Check. Nice. There's one more thing you should check before you leave. Your travel. There's a new cycleway under construction between Kensington Olympia and Brentford Town Centre, so expect delays due to lane closures at the junction of Kew Bridge Road and Chiswick High Road. Plan ahead at tfl.gov.uk. To the Mayor of London and TfL, every journey matters.
The puck drops. 12 players face off to win. The suspense is pure torture, but you wouldn't miss this for the world. TuneIn brings you every minute of the NHL season. Listen live to hockey when it matters most on TuneIn.
Go courtside with the NBA on TuneIn. With the NBA on TuneIn, hear your favorite team and players take on their biggest rivals during the biggest games throughout the year, including regular season showdowns, the 2020 All-Star Game, and the NBA Finals in June, featuring the home and away calls for all 30 teams. Plus, with the NBA on demand, relive the best moments of the season by listening to the past games in their entirety. Listen to the NBA all season long on TuneIn. TuneIn remembers the life, the success, the legacy of Kobe Bryant. Buckle up for Kobe! Five-time NBA champion.
It was my dream to be a Los Angeles Laker.
Repeat! Back-to-back titles! Devoted husband and proud father of 4 daughters.
I love having girls. They're awesome, man.
People are in disbelief that this global and cultural icon could be gone.
Search Remembering Kobe Bryant on TuneIn for podcasts and interviews of the legend, Kobe Bryant.
Want to hear about the latest and greatest things to listen to on TuneIn? For reminders of the biggest live sports games, debates, and breaking news stories, follow @TuneIn on Facebook, Twitter, and Instagram to stay connected with the audio that matters to you.
TuneIn is your ticket to on-the-glass NHL action. With the NHL on TuneIn, listen to every one-timer, hear every stick save, and experience every goal for every team across the league.
Featuring home and away feeds for all 31 teams.
TuneIn brings the excitement of the NHL home to you all season long. Plus, with NHL On Demand, skate back in time and relive the best moments of the season while listening to past games in their entirety. Listen to the NHL on TuneIn.
Search NHL today.
24 hours a day at Bloomberg.com, on the Bloomberg Business app, and on Quick Take by Bloomberg. This is Bloomberg Radio. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Jason Kelly on Bloomberg Radio.
Live from the Miami Convention Center, we are live on Radio Row. Carol Masser along with my co-host Jason Kelly on this Fed decision day, and of course awaiting that latest Fed decision. And the Fed decision is out as expected, though.
Leaving the benchmark rate unchanged, says policy is appropriate. They are lifting the IOER rate 5 basis points, and we'll be looking at that reverse repo to 1.5%. The Fed extending repo operations at least through April. That is one thing that Wall Street has been very closely watching.
All right, and I'm just taking a quick look in terms of market reaction. Looks like equities are certainly pretty much so far staying pat in terms of where they were prior to the release of that information. And I'm just checking on that 10-year. It, too, is pretty much staying where it is. So we're not seeing too much reaction. I think widely expected what we were going to get from the Fed today in this first meeting of 2020. But nonetheless, that press conference will be very key in terms of predicting a little bit of outlook and what he has to say about some of the big factors are out there, including the virus.
Absolutely. We're going to break that down, what the statement has. We're going to hear from Jay Powell in just about half an hour. But before we get to that and to our team's analysis, let's get to Charlie Pellet back in New York. Hey, Charlie.
Thank you very much, and good afternoon. Happy Fed Wednesday with the Dow, the S&P, and NASDAQ all higher right now. We are seeing the 10-year up 13.30 seconds. The yield there 1.60%. We've got the S&P higher by 11, a gain there of 0.4%, 32.87 right now. The Dow pushing higher by 131 points, up 0.5%. NASDAQ is up 38 points, a gain there of 0.4%. Gold up 0.3 now, 15.71 the ounce. Crude oil, West Texas Intermediate, down 35 cents a barrel, drop there of 0.7%. In addition to the Fed, the other big story today has to be earnings and earnings reactions. Lots coming out after the bell. Facebook will be among them, along with Tesla and Microsoft. Apple shares climbing to a record after last night's report, up by 3%. AMD, the other direction, down by 7%. General Electric, the major standout today, up by 10%. Recapping, we've got the 10-year up 12.30 seconds, yield 1.61%. S&P up 11, a gain there of 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, thank you so much. You are listening to Bloomberg Business Week. We're on the road, Carol Masser and myself. We're down here in Miami Beach in anticipation of the Super Bowl. Radio Row. Not everyone here on Radio Row is thinking about the Fed decision, but we are, because we're Bloomberg
Yes.
Business Week. We're going to have more from down here, but we're going to focus on the Fed for the next couple of hours. And back in our Bloomberg Interactive Brokers studio, they're watching it closely. Kathleen Hayes is here with us. She is the Global Economics and Policy Editor for Bloomberg, and Bloomberg News Stocks Editor Dave Wilson as well. Dave, I want to start with you. The equity picture here.
Well, really, barely a ripple in response to the Fed's latest moves, or lack of moves, let's put it that way, which leaves you to fall back on earnings, as Charlie Pellet was suggested. You know, on the one hand, you look at a General Electric being up more than 10% and say, it looks like, their CEO, Larry Culp, is steering the company out from under, you might say, because, you look back a year or two and there was real concern about GE's finances. Now they're talking about free cash flow to do things like pay debt, pay dividends, $4 billion possibly this year, and analysts only expecting $2.2 billion on average, and that's quite the gap in GE's favor.
Right. Dave, hang on a sec, because we do want to get into, it's such an interesting time. We've got a lot of earnings going on, and a lot of investors really hang on that. But at the same time, it is the first Fed meeting of the year. And Kathleen, I do want to bring you in. What stands out for you? Anything there that we weren't expecting?
No. I would say... Well, some people were thinking that the Fed would announce a new repo facility. I get a little bit ahead of the story because they didn't. They did extend their repo operations for a couple more months at least, but nothing like something that would replace the current system. And everything else was exactly as expected. They said, unemployment's low, consumption's hanging in there. Okay, investment's weak and exports are weak, but they're still pretty pleased with the economy. They're going to leave the Fed funds right where it was. That is consistent with what they, sort of forecast for us, or said this is what we think is going to happen. In December, they said that. January, they're following through. The one thing they did change was maybe one of the sources of speculation. The funds rate sunk down a little too low, so they had to raise the interest on excess reserves rate. And 5 basis points, it's sort of technical unless you're really in the markets, but nevertheless, it's not really a market mover. I guess people are just glad to see it. It's really kind of hard to pull anything out there where this puts all the more focus on the press conference, because one of the things people want to hear is the Fed, is Fed Chair Powell looking at the coronavirus and saying, well, gee, yes, we're watching that. If it should get a lot worse and really hit that global economy hard and therefore hit the United States, yeah, it could have an impact on policy. I think people are wondering where he stands there. But, this is what people were expecting until there's a material change in the economic outlook, as Powell said over and over again. He'll probably say it again today. The economy's in a good place until there's this big fundamental change up or down. Inflation starts rising, the economy fully pulls. The consensus view is we're not going to make a move.
And so, Dave, we're obviously going to have some of our reporters in the room asking Jay Powell questions. They're going to be talking a lot about the state of the economy. If you're an investor, what do you want to know from Jay Powell? Is it virus related? Is it U.S. economy related? Is it global economy related? What are you putting to him in the room?
Well, you're putting to him, are we kind of full speed ahead at this point in terms of where policy's going? Because there's the thought, Kathleen was alluding to it when she talked about the repo facility repurchases, which the Fed has done to kind of keep the plumbing in good working order in the financial system. Is there going to be more of that? How do the policymakers kind of look at the functioning of the financial system at a time when we're seeing stocks setting records, or at least darn close to it when you look at today's trading?
Let me jump in with something, because the repo facility is what we're waiting to see them put into place. Because what they're doing now is what they did up until the financial crisis started. They regularly added and drained reserves. We've got a big balance sheet now. A lot of things have changed. So suddenly they need to add reserves again. They're doing it the old-fashioned way. One of the new fashions way would be allow the banks to say, well, we got all this government. We've got treasuries sitting on our books. We're just going to change those in for some bank reserves, and then we can directly put them out, just the amount we need, to the people who want them. Jay Powell, though, at the last press conference when he was asked about the repo facility, I remember him saying, oh, yeah, we're looking at it, but we've got more important things in front of us. I think that right now the Fed, certainly Powell at that meeting, seemed to feel like we're doing fine with repo operations. We're keeping liquidity in the system. We're keeping the repo rate down so it doesn't choke off the kind of activities we need to have going on in the financial system. So he'll probably get asked about it again today. It'll be interesting to hear what he says.
Yeah, it's interesting. I'm looking at our Bloomberg Live Fed blog. Luke Howa, a markets reporter, and he's got a graphic up there. And just, I guess, in terms of market reaction, it's like snoozer. And he goes, it's down to Powell because markets certainly aren't moving off of two words changing. Kathleen, if there was something you wanted to ask Powell in connection with the virus, and I only ask because I feel like there's a lot of, even Apple commented on their earnings. Like, CEOs are reacting pretty quickly about the impact.
And Kathleen,
airlines shutting down, people moving back and forth.
And not for nothing, Kathleen, we know through Daybreak Asia, you're talking about this more than just about anybody stateside. So what's the question for Powell here?
Oh boy, what are you going to be watching for with the virus as it progresses? If it progresses, brought under control, not right. What's the chain that you're looking for? Because remember, you guys, last year when they were trying to figure out if they were going to stop cutting rates, for a long time the reason was the global economy is slowing down. We're fine, but other countries are slowing down, and that hurts us. So maybe that's the way you pose the question. Compare this to last year. At what point does this become that kind of a risk that would influence the course of policy?
Dave Wilson, got about a minute and a half here left. You did mention GE, and earnings are our other focal point right now when it comes to investors. What else do we need to know here at 2:09 Wall Street time on a Wednesday?
Well, kind of the other side of the coin is a bit of an interruption in the chip makers, in the sense that you got people who've been anticipating that business is going to pick up after a slump, the last several quarters. And then you see the numbers out of Advanced Micro Devices and also Xilinx. And there we're talking about the two worst performers on the day in the S&P 500, because in both cases, first quarter forecasts came up short of what the analysts were anticipating. AMD down almost 7%, Xilinx lower by more than 9.5% right now.
Yeah, and different from what we heard from some of the other big chip players like Intel, right? And
absolutely, Intel's results out last week, better received. No
Can
question.
I interject something? Have fun, you guys, and I want to hear about everything that happens on the air and off.
All right. Well,
Hey, what happens in Miami stays in Miami. Jinx.
All right. Thank you, guys. We really appreciate it.
That slogan. You figure Miami is the place for it. Is that it?
Listen.
That's just how at Bloomberg Business Week we roll.
We roll. It just happens.
All right.
All right. Thanks, guys. Kathleen Hayes, Dave Wilson, thank you so much. The Focus on the Fed, it's brought to you by Commonwealth Financial Network. For the 6th straight time, J.D. Power ranks Commonwealth #1 in independent advisor satisfaction among financial investment firms. Visit commonwealth.com to learn more. Let's do the Bloomberg Markets, the Bloomberg Business Week bite of the day. It's a good one, appropriate to us. It's one number that tells us a lot. Today's number, Carol, it's 11.
That's right. This year's big game is being held in Miami for the 11th time in Super Bowl history. That's the most of any NFL city. First was back in 1968, Super Bowl 11. Two, thank you, at the Orange Bowl. I forget my Greek numerals, man. All right, that famed venue hosted 5 championship games. In 1989, we had Super Bowl 22. There you go. Was played at the stadium built by and named for former owner Joe Robbie. We were talking about that earlier. And that location, now known today as Hard Rock Stadium, has played host to 6 championship games, including this year's matchup between the Chiefs and the 49ers.
Yeah.
We talked to Jim Allen, too.
We did. We talked to Jim Allen. I mean,
Hard Rock.
This place is definitely bumping, as I said earlier, to David Weston in a big way.
Great for the economy, too, right?
Speaking of press conferences, Roger Goodell has been giving a press conference this afternoon. We're going to bring you some headlines for that later on. First, let's get up to speed on world and national news. For that, we go to Martin DeCaro. He's in the nation's capital. Hey, Martin.
Hello, Jason. Q&A is underway in the Senate trial of President Trump. Senators have begun submitting written questions to the House impeachment managers and the president's defense team. Each will have 5 minutes to answer. The question of whether to call additional witnesses is overshadowing the proceedings. Unclear if Democrats have swayed enough Republicans to their side. Utah Senator Mitt Romney says he's on board.
I don't know where other senators are, but I know where I am. I'd like to hear from John Bolton because I think there are questions that I have that he could answer.
Leaked manuscripts of Bolton's upcoming book directly implicate President Trump in withholding military aid to Ukraine. The White House is now trying to delay publication of Bolton's memoir. Meantime, the president was busy celebrating a bipartisan achievement, the signing of the U.S.-Mexico-Canada trade agreement.
Everybody said this was a deal that could not be done. Too complicated, too big, couldn't be done, we got it done.
Democrats say they were not invited to the bill signing ceremony attended by scores of GOP lawmakers. New efforts to contain the coronavirus in Hong Kong. Bloomberg's Yvonne Mann says the government partially shut down border crossings with China.
Basically restricting transportation from the mainland, although it already has drawn some criticism from people here that this was not a complete closure of these border checkpoints. But we have seen Hong Kong at least tighten their travel restrictions.
And airlines around the world are suspending flights to China. British Airways, Iberia Airlines, the latest to take such action. The number of confirmed cases now exceeds 6,000. The number of U.S. service members diagnosed with traumatic brain injury caused by Iranian retaliatory missile attacks has risen to 50. The Pentagon says 32 of those 50 have received treatment and returned to duty in Iraq. The others sent to Germany for further testing. Global news 24 hours a day on air, and a quick take by Bloomberg, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Martin DeCaro in Washington. In Miami, Jason and Carol.
All right, Martin, thank you very much. All right, we do want to get more reaction to today's Fed decision. This is a big deal. First meeting of the year. While it was pretty predicted fairly well, really well, by economists and folks watching this decision, we still have to wait for that live press conference. That's going to happen at the bottom of the hour with Jay Powell. Steve Skanke is with us, back with us, Chief Economic Advisor at Keel Point. He is a former U.S. Treasury and White House National Security Council staff member based in Washington. He's in our Bloomberg Interactive Broker studio back in New York. Also with us is Francis Donald, Chief Economist, Head of Macroeconomic Strategy at Manulife Asset Management, on the phone from Toronto. Steve, let's start with you. So nice to have you back with us. We all pretty much called this one fairly well. What's important about this meeting, this decision so far, and what's to potentially come from Jay Powell?
Well, the meeting came off as expected, as you said. No big surprises.
Yeah.
Everything was anticipated. I think that the biggest challenges facing the Fed right now are this quantitative easing, which they don't describe as quantitative easing, adding to their balance sheet to deal with the repo market problem. They've telegraphed that that'll end after tax season in April. But I think the challenge is going to be, while they don't see it as quantitative easing, and they can explain why, the market sees it as quantitative easing. And when it stops, how they explain it is going to be very, very important so as not to leave markets spooked the way we saw at the end of 2018.
Right. Well, and for instance, Don, we remember that all too well, that really for that first period in Chair Powell's tenure, it felt like the market was cool with the statement, and then he opened his mouth and investors started selling off. He's learned a lot about communication, I think it's fair to say. But what do you read in the statement, and what do you need to hear when we do hear from Chair Powell in a bit?
Well, I think in terms of what he announces today, I'm sorry.
Well, I was going to add.
Go ahead, Francis.
The message from the statement is pretty clear, which is that Chair Powell isn't blinking. He's not blinking over coronavirus. He's not blinking on market-based inflation measures falling or oil prices falling. There's very little to chew on in this statement. He's only made 2 small changes to the language. If we're going to get any form of dovish or hawkish slant, it's going to come in the press conference. But my sense is, if they wanted to send the message that the Powell put was back on, there would have been more to digest from the statement, and there just isn't. So if we head into that press conference and we don't get some nods, some concerns, my sense is that equity markets, they might be a little irritated, for lack of a better term.
Steve, come on in on this.
Well, I agree with Francis. They're very careful in the statement. There was really nothing that they needed to say. The slight tick up in interest on excess reserves was expected. Not to have done it would have probably just caused some head scratching because everything is working so well right now. Probably the only irritant out there is some recent comments by the president about why the Fed doesn't do more to cut interest rates. But they're just going to be steady about that. They don't have to do anything about that. What they do need to be thinking about, though, is what are some additional recession-fighting tools that they need to be developing internally and thinking about so that when we come on down the line and they haven't cut rates, or even if they have cut them a little bit more than they have so far, what's going to be in their toolkit to deal with that?
Steve, I want to ask you, I'm looking at our Fed Live blog and everybody from the, our Bloomberg News team and economics team kind of weighing in. And they pointed out, one of our individuals, the Fed has marked consumer spending to market as the only real change in the statement. And here's why it's maybe worth keeping a watch on it. The annual growth in the national paychecks, so we're talking about the 12-month change in average weekly hours, average weekly pay, payrolls, has decelerated to 3.8%, its slowest rate of growth since January of 2017. Consumer, we talk about it, ad nauseum, about how important it is to the economy, obviously, and keeping things going. What are you keeping an eye on for the consumer? Anything out there that makes you a little bit nervous about whether or not the consumer is going to be able to keep up spending?
Well, I pay a lot of attention to consumer sentiment, the University of Michigan study, and the Conference Board Consumer Confidence. And right now, consumer confidence and consumer sentiment is high, and it seems to be staying there. The only slight ding in that is that the release in January by University of Michigan showed that the forward-looking outlook in terms of consumer sentiment is off a little bit. So long as they remain confident and feel safe, they will continue to spend. What we're also hoping for is that we're going to see some return of business investment, and there are signs that that's starting to appear.
I do want to bring some headlines to our audience about Lyft. There had been some reports earlier from the New York Times that Lyft was planning some job cuts as part of a broader restructuring, announcing this ahead of earnings. Bloomberg now reporting that Lyft is going to cut about 90 employees, representing about 1.6% of its staff. It says it's cutting staff also at the same time planning to hire more than 1,000 people in 2020. The stock had been down almost 4% earlier in the session. Now still down, but a little less than 2%. Coming off its lows for sure.
But definitely dipping, I would say, on those headlines.
Yeah, for sure. And, this is a company like its chief rival, Uber.
Yeah,
I can't say rival or Uber. Its chief rival, Uber, that's trying to figure out, how to make money, essentially. That seems to be the big question.
Yeah, and I think what's interesting, too, Steve, and this is something that we've been talking a lot about, whether it's a Fed decision day, whether it's trade tensions, companies are making decisions, whether it's to cut workers, spend money differently. I mean, do you feel like companies, there's enough out there for them to increase cap spending, to be more confident about the outlook?
I think that there is in many of the sectors. Interestingly, what we haven't seen much in the headlines lately is all of the retail businesses that are closing up stores and laying off thousands of employees. It's headlines of job cuts that ding consumer confidence directly. It's the old phenomenon: if someone else is losing their job, how safe is my job? And of course, I mean, it's understandable in the retail space. There's been a shift from in-store consumer spending to online consumer spending, and we've watched that evolve. But there is that vulnerability to consumer confidence in these job shifts, as the new jobs are not telegraphed as much as the jobs that are lost when these stores and shops close up.
And so Francis Donald, chief economist over at Manulife Investment Management, come on back in. I do want to ask you, sort of given what we've been talking about with the Fed, given what we've talked about and what we know so far about the coronavirus, what's an investor to do in this type of market? How do you synthesize all of this into a strategy at this moment?
Well, you have no choice but to accept that there's more uncertainty, that if you were counting on a China rebound, it might be delayed, and you have to widen your confidence intervals. And this is exactly what the Fed is going to have to do, and all central banks will have to do, is say, we just need to be a little bit more cautious as we assess the damage as it heads out. But most pandemics have showed us they turn out to be a buying opportunity. We just have to get a sense of when that might be. My bigger concern is that this is landing in a period where I suspect we're still going to have weak growth. Q1 being a problematic quarter for growth, it might compound some of that weakness and make it difficult to differentiate between what is true cyclical weakness and what is this virus compounding on top of it.
All right, so of course, let's just remind everybody at the bottom of the hour, we will hear from Fed Chairman Jay Powell, his regular press conference coming after the meeting. We will take you live there to the Fed in Washington to listen to that. So, Steve, I think I ask you this every time we're together, but what would you want to ask Jay Powell right now?
I really want to ask him what his biggest concern is in going forward and developing new tools and having to address the day of reckoning with shutting off the money spigot that they've had on since September. $400 billion in new liquidity is a lot of money, and the markets have come accustomed to it. And how would he help us understand how that's going to get tapered in a way that doesn't really change the way things work in the markets?
And Francis, let's put that question to you. What would you want to ask Jay Powell today?
I'd like to know how Chair Powell is thinking about inflationary pressures. We've had a pullback in oil. Market-based inflation expectations are lower. Average hourly earnings have pulled back. These are all deflationary pressures, and yet the Fed doesn't seem to be too worried about them in the statement. I'd like to get a sense of how much their view on that outlook has changed and what they're going to do if these problems worsen.
And those problems worsening again, I guess, Francis, I'm trying to understand. I know we talked about this a little bit, but this virus, we're still trying to get our hands around it and our arms around it, especially from an investor's perspective. When do you act on the fear or the worry at this point?
I think markets have already acted on the fear and the worry. They've already priced in a probability of the worst outcome. That's what markets do. They say, I think there's an X percentage chance that this turns into something worse than it is now. We've seen that in the market. The bigger question for me is, when do I buy again? And if Powell comes out in this press conference and says, you know what, the door is open, if this produces more damage, then, we will pull the trigger, that to me will be an important buying opportunity, just like it was in 2019.
The other thing I want to ask you guys, because I feel like this is another thing, when we were hitting the 10-year anniversary this past summer of the longest economic expansion on record, I think we were like, okay, that's it. It's got to, something's got to happen. Steve, when you look at this economy, is there more momentum to kind of keep it going like we have seen the last few years?
Well, the momentum seems to be growing, and there's an expectation that 2020 could be even better than 2019. Now, obviously, there's a lot of things that could affect that along the way, but very, you look just across the sectors, and economic growth has been robust. Employment continues to grow. Housing starts up 40% in December year over year, and another 6% in building permits. That continues to be strong. Consumer confidence, consumer sentiment continues to be strong. Small business optimism off a little bit, but continues to be strong. And so when we see what happens with business fixed investment, I think that'll tell us a lot. But if that starts to move forward, that would be a very good indicator as to where we might end up with a level of economic growth, probably somewhere in the range of 2 to 2.25% in 2020.
Right, just kind of, to some extent, more of the same. Francis, you agree with what Steve's assessment that we could keep this economic expansion still moving along?
Yeah, my sense is we've actually had 3 almost recessions in this cycle already, and had we not seen Fed cuts, Q4 this year and Q1 could have been something that looked much more like a recession. So now what we're seeing is a reacceleration, that sort of V-shaped recovery that we see after these weak economic times, and that can persist through the second half of 2020. But there are still some missing ingredients that make this a robust recovery, and the biggest one is, where is China's stimulus? It's not as powerful, it's not as international as it used to be. We're still looking at some elevated global debt levels that are relevant to this. I'd like to see a weaker U.S. dollar help contribute to that rebound. There's some components here that are not quite like those past recoveries. So can we muddle through? Absolutely. But we still got to get through a rough Q1. Let's not discount the fact that global growth hasn't yet turned. Global trade still falling. World industrial production still falling. Real car loading still falling. We're not out of the woods yet.
All right, going to leave it on that note. Thank you so much. I really appreciate both of yours insights and analysis. Steve Skanke, Chief Economic Advisor at Keel Point, back in our Bloomberg Interactive Broker Studio. Francis Donald, Chief Economist and Head of Macroeconomic Strategy at Manulife Asset Management, on the phone from Toronto.
All right, so we're getting a sense that at least the statement, slightly a nothing burger, which was predicted, and I'm using a technical
sometimes a nothing burger
term.
Is not a bad thing.
Yeah, sometimes a nothing
Markets
burger
don't
is
always
very
like surprises.
tasty. All right, let's get some headlines from Charlie Pellet. He's watching the market reaction and also the broader business world. He's back in New York. Hey, Charlie.
Hi, thank you very much. We have got the Dow, the S&P, and NASDAQ all moving higher right now. We are minutes away from the Fed conference, Fed news conference with Fed Chair Jay Powell. The Dow, the S&P, and NASDAQ advancing, as I mentioned. Federal Reserve keeping its key interest rate unchanged. Reaction from Francis Donald, head of macroeconomic strategy at Manulife Asset Management, who was our guest moments ago right here on Bloomberg Business Week.
Well, you have no choice but to accept that there's more uncertainty, that if you were counting on a China rebound, it might be delayed, and you have to widen your confidence intervals. And this is exactly what the Fed is going to have to do, and all central banks will have to do, is say, we just need to be a little bit more cautious as we assess the damage as it heads out. But most pandemics have showed us they turn out to be a buying opportunity. We just have to get a sense of when that might be.
The Fed today continuing to signal policy will stay on hold for the time being as the U.S. enters a presidential election year. 10-year up 30 seconds now with that yield 1.60%. Gold up 0.4%. Again, the Dow, the S&P, NASDAQ all higher. S&P up now by 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. We're live, Jason Kelly and myself, live in Miami at the Miami Convention Center, Radio Row. So we're going to bring you some conversations with former coaches and players here talking about the big game. But of course, our focus right now is the Federal Reserve, and widely as expected, the Fed leaving rates unchanged, pretty much exactly what we got, and in terms of market reaction, really haven't seen too much market reaction. Right. But now we turn to the press conference, which we will see in just about 10 seconds. Jay Powell expected to step up to the podium, take questions from the reporters that are in the room, certainly the economic outlook, certainly the virus on everyone's mind. A little bit later on, don't forget, we've got some big earnings, Facebook coming out with earnings after the close. Let's head to Washington and to Jay Powell.
At today's meeting, my colleagues and I decided to leave our policy rate unchanged. As always, we base our decisions on our judgment of how best to achieve the goals Congress has given us: maximum employment and price stability. We believe monetary policy is well positioned to serve the American people by supporting continued economic growth, a strong job market, and a return of inflation to our symmetric 2% goal. The expansion is in its 11th year, the longest on record. Growth in household spending moderated toward the end of last year, but with a healthy job market, rising incomes, and upbeat consumer confidence, the fundamentals supporting household spending are solid. In contrast, business investment and exports remain weak, and manufacturing output has declined over the past year. Sluggish growth abroad and trade developments have been weighing on activity in these sectors. However, some of the uncertainties around trade have diminished recently, and there are some signs that global growth may be stabilizing after declining since mid-2018. Nonetheless, uncertainties about the outlook remain, including those posed by the new coronavirus. Overall, with monetary and financial conditions supportive, we expect moderate economic growth to continue. The unemployment rate has been near half-century lows for well more than a year, and the pace of job gains remains solid. Participation in the labor force by people in their prime working years, ages 25 to 54, is at its highest level in more than a decade. And wages have been rising, particularly for lower-paying jobs. People who live and work in middle-income communities and low-income communities tell us that many who have struggled to find work are now finding new opportunities. Employment gains have been broad-based across all racial and ethnic groups and all levels of education. These developments underscore for us the importance of sustaining the expansion so that strong job market reaches more of those left behind. Inflation continues to run below our symmetric 2% objective. Over the 12 months through November, total PCE inflation was 1.5%, and core inflation, which excludes volatile food and energy prices, was 1.6%. Available data suggests similar inflation readings for December, though we expect inflation to move closer to 2% over the next few months as unusually low readings from early 2019 drop out of the calculation. While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead longer-term inflation expectations to drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well, closer to their effective lower bound. As a result, we would have less room to reduce interest rates to support the economy in a future downturn, to the detriment of American families and businesses. We have seen this dynamic play out in other economies around the world, and we're determined to avoid it here in the United States. In particular, we believe the current stance of monetary policy is appropriate to support sustained economic growth, a strong labor market, and inflation returning to our symmetric 2% objective. As long as incoming information about the economy remains broadly consistent with this outlook, the current stance of monetary policy likely will remain appropriate. We will be monitoring the effects of the policy actions we took last year, along with other information bearing on the outlook, as we assess the appropriate path of the target range for the federal funds rate. Of course, if developments emerge that cause a material reassessment of our outlook, we would respond accordingly. Policy is not on a preset course. I will conclude with a brief overview of our current plans for our technical operations to implement monetary policy. The plan the FOMC announced back in October to purchase Treasury bills and conduct repo operations has proceeded smoothly and has succeeded in providing an ample supply of reserves to the banking system and effectively controlling the federal funds rate. In light of the resulting stability in the federal funds rate and money market conditions more generally, we decided to make a small technical upward adjustment to administered rates to ensure that the federal funds rate trades well within the target range. This action reverses the small downward adjustment made in September when money markets were volatile. As our bill purchases continue to build reserves toward levels that maintain ample conditions, the role played by active repo operations will naturally recede. Over the first half of this year, we intend to adjust the size and pricing of repo operations as we transition away from their active use in supplying reserves. This process will take place gradually, and as indicated in today's FOMC directive to the desk, we expect to continue offering repos at least through April to ensure a consistently ample supply of reserves. Based on current projections, we expect that the underlying level of reserves will durably reach ample levels sometime in the second quarter of this year. As we get close to that point, we intend to slow the pace of purchases and transition to a program of smaller reserve management purchases that maintains an ample level of reserves without the active use of repos. At that point, as in the pre-crisis period, our balance sheet will be expanding gradually over time, reflecting the trend growth in the demand for currency and other Federal Reserve liabilities. All of these technical measures are designed to support the efficient and effective implementation of monetary policy and are not intended to represent a change in the stance of monetary policy. We're committed to completing the transition to our longer-run ample reserves regime smoothly and predictably. Of course, we will continue to closely monitor conditions in money markets, and we will adjust these plans as conditions warrant. Thank you, and I'll be happy to take your questions.
Thank you, Chris Condon, Bloomberg News. Mr. Chairman, I would like you to comment in a little bit more depth about one small change I've noted in the statement. It notes that policy will be appropriate to bring, the committee believes, inflation back to the committee's 2% symmetric inflation objective. That's a slight change from the last time when you were expecting it to bring inflation outcomes back near the objective. And I would put this also in the context of a comment you made at the last press conference where you drew attention to the fact that a number of policymakers had projected inflation overshoots 2 and 3 years out under appropriate monetary policy. Should we take all of this together to mean simply that the committee is more confident that a 2% outcome for inflation is already baked in the cake, or that this is a signal that the committee has a stronger resolution to bring inflation at least to the 2% objective and bring into play an informal make-up strategy for inflation? Thank you.
Yeah. So in making that change, our goal was really, that was changing near to returning to, was to avoid possible misinterpretation. So you may remember in the December minutes, we noted that a few committee members suggested that the language that stated that monetary policy would support inflation near 2% could be misinterpreted as suggesting that policymakers were comfortable with inflation running below that level. So we thought about that in the intermeeting period and concluded that it would be appropriate to adjust that language to send a clearer signal that we're not comfortable with inflation running persistently below our 2% symmetric objective. So yes, there is something in that. It's just that we wanted to underscore our commitment to 2% not being a ceiling, to inflation running symmetrically around 2%, and that we're not satisfied with inflation running below 2%, particularly at a time such as now where we're a long way into an expansion and a long way into a period of very low unemployment when, in theory, inflation should be moving up.
Thank you. Nick Timmeros of the Wall Street Journal. I want to ask about the balance sheet. How many reserves are ample? How many reserves does the Fed now think it will need to conduct policy in its current framework? And can you walk me through how you and your colleagues are arriving at that answer?
Sure. So thanks for that question. Why don't I say a few things about repo, since I know that'll be of interest. So just to bring you back, after last September's brief turmoil, we took prompt and decisive action, and as a result, money markets have been operating smoothly since then. Just to review, those two adjustments were Treasury bill purchases of $60 billion, at least into the second quarter, and term and overnight repo at least through April. And I will get to your specific question. The purpose of the adjustments has been to assure that our policy is transmitted smoothly to the federal funds rate, which requires well-functioning money markets. That doesn't mean we're trying to eliminate all volatility in the repo markets. We know that some volatility is normal and expected in well-functioning markets. And as I mentioned, these adjustments have been successful in supplying an ample quantity of reserves. Money markets operated smoothly, including right through year-end, and the Fed funds rate has remained in our target range. So we will know when these adjustments have run their course, when reserves are durably at a level that enables us to control the federal funds rate using our administered rates, interest on reserves and reverse repo, without the need for frequent use of open market operations. Based on current projections, we expect that the bill purchases will durably bring the underlying level of reserves to the ample level sometime in the second quarter of this year. And when we see that we've reached that level, we'll begin to gradually reduce our asset purchases to the level of the underlying trend growth of demand for our liabilities. As our bill purchases bring the underlying level of reserves up to an ample level on a sustained basis, the necessary quantity of overnight and term repo will gradually decline. We've already begun the gradual reduction in the quantity of repo, and we'll continue to reduce those offering amounts gradually as conditions permit. At some point, we'll also raise the minimum bid rate. Even after we reach an ample level of reserves, it's possible that repo operations might play a role as a backstop and support effective control of the federal funds rate. And we'll continue to discuss that issue in reviewing our implementation framework. Coming to your question, in terms of the actually desired reserve level, we know that reserves will continue to move up and down over the course of the calendar year in a wide range, depending on volatility in non-reserve liabilities, particularly the Treasury General Account, or TGA. In particular, reserve levels will need to be at a level high enough to remain ample, even when the TGA peaks during the April tax season. Effectively, what that means is that we need reserves at all times to be no lower than they were in early September, and I would say around $1.5 trillion, subject to learning more. Reserves are going to move in a broad range, as I mentioned, and we want to be clear, that will be the bottom end of the range. We want $1.5 trillion or thereabouts to be the bottom end of the range. So most of the time, reserves will be moving in a range substantially higher than that, but not going below $1.5 trillion. So it's not something that we're aiming at all the time. We know that reserves will fluctuate and be substantially higher than that most of the time. We also want interest on excess reserves and the Fed funds rate to be well within the FOMC's target range, and we think that'll be the case now that we made our technical adjustment. Last points, we're committed to making this adjustment process a smooth one. We'll provide more details as we go, and we expect to learn as we go, as we always have. And we're prepared to adjust the details of the plan as necessary to foster efficient and effective monetary policy implementation.
Steve Leisman, CNBC. Mr. Chairman, thank you for the question. Following up on Nick's question, I know you said it's not QE, but it's $390 billion over 5 months, which is a lot to expand the balance sheet. I guess I'd ask one more time on Nick's question, is there a number that you have in mind? Secondly, a lot of people in the market are sort of concerned that it looks like QE and they're trading that way. Are you concerned that the market is embracing this like a QE program and that the rise in the stock market is linked to it, and you may then experience something of a taper tantrum the way Chairman Bernanke did when he tried to roll it off?
So I'll just I'll repeat that we think we need to continue purchases until reserves are at a level at which they will not go below $1.5 trillion roughly during the course of the calendar year, and we know that the TGA will move up and down. So they'll be much higher than that some of the time. But that's kind of the number, and we think we'll reach that sometime in the second quarter. That's our estimate, but we'll know it when we get there. We'll know it because we'll be able to control the federal funds rate without use of without active use, ongoing use of open market operations. Our intention of these for these adjustments is just to raise the level of reserves and to allow us to conduct monetary policy in an efficient and effective manner, and that is our sole intention. I pointed out on other occasions more than once the differences, the really specific differences between this and the large-scale asset purchase programs. We've been over that. In terms of what affects markets, I think many things affect markets. It's very hard to say with any precision at any time what is affecting markets. What I can tell you is that what our intention is. It is to return reserves to an ample level. We expect that to happen during the second quarter. And our plan as we do that is, as those purchases get to that level, we believe we can gradually reduce them, and we believe we can also gradually reduce repo as we reach an ample level, as we're satisfying demand now more from underlying reserves from bill purchases rather than from repo. And again, last thing I'll say is we're prepared to adjust the details of this plan, as we've shown ourselves willing to do, depending on conditions.
Gina. Hi, Chair Powell. Gina Smiley from the New York Times. I was hoping that you could talk a little bit about the labor market. We've recently seen wages moderating a little bit by some measures, maybe even declining a little bit by others. As you mentioned, at the lower end of the sort of talent pool, it seems like we are seeing those wages climb up a little bit, but it doesn't seem to be consistent across the entire sort of average. I was wondering if you talk a little bit about whether you guys are noticing any cracks, or whether you're worried about that, or how you're thinking about it.
The labor market continues to perform well. The labor market continues to be strong. We see strong job creation. We see low unemployment. Very importantly, we see labor force participation continuing to move up, really against expectations. If you go back a few years, you will not find a lot of forecasts suggesting that we could have been at 63.2% overall labor force participation, or the levels of employment to population that we're seeing now, let alone the unemployment level. So I think we've learned quite a lot of good things about the labor market, good things suggesting that there's been more room to run. The performance of wages, I think, has to be seen in that context. We saw, if you go back 4 or 5 years, the 4 or 5 major wage statistics that we track were running at around 2%, and now they're running at around 3%, which is theoretically about where they might be at full employment. It would consist of inflation plus productivity growth. It's a bit surprising that with sustained levels of historically low unemployment, we haven't seen wages moving up above that level, as we have in other long expansions and other periods of low unemployment. So you ask what can be explaining that? One thing can be that the natural rate of unemployment is still lower than we think, that the labor market is not as tight as it would appear just from the 3.5% number. And the other can be, I think, that, as I mentioned, the sort of supply side shock or surprise that we're receiving from higher labor force participation. People are coming into the labor market and providing more labor supply, and that is it's a great thing. That's a very healthy thing. We're a country that has low labor force participation compared to essentially all of our advanced economy peers, and it's a very good, positive thing. Nonetheless, it represents more labor supply, and it may be holding down wages.
Michael McKee from Bloomberg Radio and Television. In terms of the framework review, and a little bit on Chris's question earlier, there is a general feeling now in the markets and among analysts that you're basically setting us up for some form of inflation target averaging, where you let the inflation rate run above the 2% target for some time to make up for the time that it is spent below that. Is that a fair or reasonable assessment of where you think you're going to end up? What would you, Chairman Powell, think of that idea personally? And as long as I'm asking, do you have any more details on when we can expect the results of the review?
Thanks. I'll just say that we undertook the review because we felt, and I felt, that it was time to incorporate the realities of what we could call the new normal into our policy framework. And some aspects of that new normal would include ongoing, powerful global disinflationary trends, which have led to lower than target inflation many places in the world. Secondly, a flat Phillips curve, by which I mean low levels of sensitivity of inflation to resource utilization, for example, low unemployment. And thirdly, a much lower neutral real interest rate here and around the world. So those are challenging conditions for monetary policy to deliver on our statutory goals of maximum employment and stable prices. Although I would say that under our existing framework, we've been able to succeed or get close to succeeding it for most of the time lately to achieve those goals, although we do struggle, as other central banks do, with the inflation goal. So this is about reviewing our strategy, tools, and communications to assure that they're the best that we can do to achieve those goals in this environment on a sustained basis. And we continued our discussions at this meeting. I'm very, very pleased at the process so far. It's included the 14 Fed Listens events around the country at which we've engaged with a full range of people and groups across American society. That was a very, very positive experience, and I think we learned a lot. We've now had a number of FOMC meetings at which we've reviewed what we've learned and also dug deeply into strategy, tools, and communications. I expect that we will conclude the review and announce our conclusions around the middle of the year. Right now, we're just at the point of coming together to put all that together. So I think I'm not the person who should be telling you my personal preferences right now. We're trying to come together as a group around a set of answers. I feel very positive about that we're going to come up with some good results, and I'm just going to have to wait until we get to that point to announce them.
Donna Borak with CNN. Going back to your outlook for global growth, we've seen some significant headwinds, as you mentioned earlier, with the easing, with the partial U.S.-China trade deal. But now that there's some new concern following the outbreak of the coronavirus that it might shape global growth. We're already seeing reports from Ford and Toyota that they're planning to shut down their assembly plants for an extra week. Apple is rerouting their supply chains. Starbucks is shutting down close to thousands of stores. Are you worried at all about what the impact would be on the U.S. economy? And do you see that as a significant risk, to the outlook at this point?
So let me talk about coronavirus specifically, and then I'll turn more to global growth more generally. First, it's a very serious issue, and I want to start by acknowledging the significant and considerable human suffering that the virus is already causing. There is likely to be some disruption to activity in China and possibly globally based on the spread of the virus to date and the travel restrictions and business closures that have already been imposed. Of course, the situation is really in its early stages, and it's very uncertain about how far it will spread and what the macroeconomic effects will be in China, in its immediate trading partners and neighbors, and around the world. So in light of that uncertainty, I'm not going to speculate about it at this point. I will just tell you that, of course, we are very carefully monitoring the situation. As you suggested, our framework ultimately is what are the potential ramifications for the U.S. economy and for the achievement of our dual mandate. More broadly, though, if I can talk about the global economy for a second, and if you look at the backdrop, if you go back to 2017, that was the year of synchronized growth that lasted to the middle of 2018, and then you saw a slowing in growth, which lasted right through the end of last year. The fourth quarter growth globally was quite weak last year, and a number of factors played into that. It wasn't any one factor. There was trade policy uncertainty, absolutely, but also there was the decision by the Chinese authorities to try to rein in leverage and financial excesses. There was a downturn in the global high-tech manufacturing cycle, in global auto production. There were some idiosyncratic strains in some countries like Argentina, Turkey, and then later in Hong Kong and Chile, you had social unrest. So all of those things were playing into that cycle of weakening growth over the course of 2019 and the last half of 18. I would say now there are grounds for what I would call cautious optimism about the outlook now for the global economy. Many analysts are predicting a pickup in growth this year, although still to relatively modest growth rates. And we would point to supportive financial conditions, the easing of trade tensions, the lower odds of a hard Brexit. the high-tech manufacturing industry does appear to be rebounding well in Asia, including in China. The latest indicators, manufacturing PMIs, for example, suggest that manufacturing may have bottomed out, that they're still below 50 in many jurisdictions, but they have moved up off of their lows. I would just say none of this is assured. As I mentioned, we saw the fourth quarter of last year came in quite weaker than expected. We are not at all assured of a global rebound, but there are signs and reasons to expect it. And then comes the coronavirus, which again, it's too early to say what the effects will be. Of course, we're, as I mentioned, monitoring it carefully. There will clearly be implications, at least in the near term, for Chinese output, and I would guess for some of their close-in neighbors, and we'll just have to see what the effect is globally.
Brennan?
Brennan Greeley with the Financial Times. As recently as 2018, interest on excess reserves was at the top of the band, sort of dragging the Fed funds rate up. Over the course of the adjustment since last year, it's moved steadily down, closer to the bottom of the band. So if you're moving it back up, how high do you want to get it? Are we looking to get interest on excess reserves at the top of the band again as the Fed fund rate moves to the middle of the band? And should we see movements in IOER as an indicator that we're approaching ample?
So our stated goal is to keep IOER and the federal funds rate well within the range. That's it, well within the range. And that clearly, 5 basis points from the bottom or from the top isn't that. So that's why we moved back up. You're right. Last year we saw some tightness as reserves were draining out of the system. We saw the gradually moving up, and in hindsight, we know what was happening. With ample reserves, we see that it's possible to bring the interest on reserves rate up to 10 basis points. So now we are well within the range, I would say.
We are. So you don't think that as Fed funds goes back up towards the center of the range, that IOER is going to end up at the top?
Don't know that. We want it to be well within the range. I think we'll continue to adjust it to the extent it's appropriate. Ultimately, what we're trying to do is deliver a federal funds rate that's well within the range. IOER is just a tool to do that. If we need to make changes to keep it well within the range, we'll do that. It just means, the thing that matters for the economy is that we keep the federal funds rate, which is the rate that, of course, transmits into other money market rates, which ultimately transmit into all kinds of financial conditions. That's what we care about. So ultimately, we will use that tool to keep it well within the range.
Howard?
Thank you, Howard Schneider with Reuters. Just to sort of close the loop on one thing, where do discussions stand on a standing repo facility? Because what you've said so far sort of implies that there won't be one, or there'll be a very limited one. So if you could just, let us know where that discussion stands. And also, sorry about that. Did you get the question? Did you hear the question okay?
I did. Okay. I'm not sure your colleagues did.
Where the discussions stand on standing repo. That was great. And the other thing is on the standing repo facility and on the purchases, Treasury bill purchases, as you enter this new regime later in the second quarter or later in the year, will that be pre-announced by amounts? Will it be preset amounts like you're doing now, or will that just be something that people will have to sort of intuit and figure out as you go along?
So I'll go in reverse order. When we make decisions about the steps we're going to be taking in that adjustment process that I described at some length, we'll be making them as early as we can and as transparently as we can. And specifically, but we're not at that stage. It's January, and we're several months away from that. In terms of the standing repo facility, as I mentioned in my answer to an earlier question, there may well be a role for repo in this system, even after we're at an ample reserves level. Now, we haven't decided what that role is. We have not decided. We haven't at all made a decision on the standing repo facility. We haven't. We've had a couple of discussions about it, as you know, back in, June and October, and there's a range of views. We're going to return, I would say, fairly soon to this question, and I think it was wise to wait because we're still getting a better sense of what that world looks like. And, it's really going to be a question of how useful will it be, what will be the costs and benefits. And My thinking is we will return to that fairly soon, and I wouldn't assume a decision one way or the other. Really, we haven't made one because we haven't had to, and I think when you delay, you get more information by waiting. It's good to wait. We don't have any urgency in making that decision because we're still trying to find that sort of stable equilibrium where we're in an ample reserves regime.
Heather? Heather Long from the Washington Post. I'm wondering, do you think that there is a financial stability risk from climate change? You've spoken several times that you think severe weather events are happening more often and that the Fed is monitoring what that could physically do to a bank or a financial institution, but that's sort of one institution. Do you think there's a system-wide risk that could develop from climate change?
So that's an interesting question. The question being, is there a system-wide financial stability risk? I'd say over the longer term, it's certainly possible. And I would say that's sort of feeds into the way we're thinking about climate change as an institution. So as I've mentioned, climate change is an important issue, a very important issue, but it's essentially assigned to many other agencies in the federal government and state governments for leadership on that. And importantly, society's overall response to climate change needs to be decided by elected officials and not by the Fed. All of that said, if you look at our mandate, we've got a monetary policy mandate and more immediately perhaps a supervisory mandate where we're supervising financial markets, utilities and financial institutions, banks, and we share overall responsibility for financial stability with a number of agencies. And that latter part, I think the public has every right to expect and will expect that we will assure that the financial system is resilient and robust against the risks from climate change. Now, I think that's got to be right. We are in the very early stages, as are other central banks, in understanding just what that means. And there's quite a lot of work going on around the world at other central banks and at the Fed to think that through. But I do think it's in that sense it has to be part of our role, but not the overall response of society to climate change. That's not us.
And if I could follow up, could you clarify why the Fed hasn't signed on to the network for greening the financial system like 40 other central banks have?
So we've attended all of their meetings and taken part in them. And we've been looking at joining in one form or another and talking to them about that. We probably will do that at some point. So that's an ongoing question. But we're very much attending those meetings and taking part in them.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business Network. So there was a signing of a ratified USMCA at the White House today. Mid-February, the Phase 1 China deal goes into effect. Have you seen business investment pick up at all? If not, what will it take to get that business investment going as this uncertainty is being cleared up?
Yeah, so I guess I'd start by saying that the fact that we've reached a Phase 1 deal with China and the fact that we've moved ahead closer to getting USMA agreed, those are potentially positive things for the economy, without question. And financial markets, the reaction of financial markets is very consistent with that perception. A sustained reduction in uncertainty over time should improve business sentiment and investment, which would provide some additional support for the economy. It's important, though, to bear in mind a couple of things. First, trade policy uncertainty remains elevated. Businesses continue to identify it as an ongoing risk. We still have 2 or even 3 active trade discussions that are going on in the public square right now. So it hasn't gone away, and we've just come through a round of talking to our vast network of contacts in the business world, and I think clearly these are seen as positive developments going forward, but there's a bit of a wait-and-see attitude. Is this going to be sustained? The agreements have to be implemented, too, and that'll take quite some time. So I would say we need to be a little bit patient about the effect on the economy. There's also the global economy. You could well see manufacturing, as I mentioned, manufacturing PMIs have started to tick up consistently among both advanced economies and emerging market economies. We do not see a decisive recovery, but it's possible that this mix of positive developments and also accommodative financial conditions could spur further growth.
Michael Derby.
Hi, Mike Derby with Dow Jones. Do you have any greater sense of what was going wrong with the repo market starting in September? There seemed to be, whether it was a one-off event, tied around tax payments and debt settlement, or whether there's a more enduring issue going on with the market, more structural forces that are basically gumming up the repo sector.
Yes, as for those forces, so as we indicated, we would undertake a serious review of that question and look at both regulations and also supervisory practices, and we'd be prepared to adjust those in ways that might encourage liquidity to flow more easily in the system, as long as it didn't undermine safety and soundness. And so we've undertaken that. We've done a ton of work. I actually don't have anything to announce here today, but I feel good about what we've learned there. I think you mentioned other factors. We will be announcing our findings. I'm not going to give you a time, but we're well along in that assessment at this time. I think we also found out, though, that the level of reserves that we need in the system to conduct our operations without frequent resort to open market operations was higher than we had thought, and it was higher than others had thought too. We learned that we shouldn't let reserves go below $1.5 trillion, roughly the level of early September, at any point. And that means that reserves will move in a range over the course of the year that'll be substantially higher than 1.5, but they won't ever go below. So 1.5 is not a target level. It is the bottom of a range in which reserves will be expected to move.
Hi, Mr. Chairman. Just wanted to ask about how your balance sheet operations and temporary repos, how they affect the system and who they're helping. Clearly, they're mostly designed, as you said, to keep the Fed funds rate in the range you're looking for. But certainly, the repo market is also used heavily by hedge funds and other Wall Street institutions. And so, how would you explain to sort of Main Street why you're doing all this for that market, and how would you address criticism that it is helping mostly Wall Street along with everything else? Thank you.
Let me just stress that we have a very specific and important reason for caring about money market operations generally, and that just is that our monetary policy decisions are transmitted through the financial markets, through the money markets, into other financial markets and into broader financial conditions. So we care that money markets are operating smoothly, and they stopped operating smoothly briefly back in September, and so we acted. This is a one-time thing that we're doing to adjust the level of reserves so that the money markets will be able to operate smoothly on an ongoing basis. Repo markets are important because that's where Treasury securities, the purchase of Treasury securities, which is the way part of the way the federal government is funding its operations. It's the way those are financed. So these are largely Treasury securities that have been purchased by dealers for distribution to end buyers to a substantial extent. That's what's going on in the Treasury repo market. So it's just financing for that. Now, again, that activity is a market activity. We're not looking to eliminate volatility or protect anybody from volatility at all. What we care about is that volatility in the repo market can affect the transmission of our policy decisions to federal funds rate, and that really is important for the public.
Nancy Marshall-Genzer with Marketplace. Chair Powell, is the Fed going to vote tomorrow on changes to the Volcker rule restrictions on banks investing in venture capital funds? What can you tell us about what the Fed is considering and why make those changes?
Sure. So we will be looking tomorrow and voting on a new part of the existing Volcker rule, and that is the covered fund provisions of the rule. And we'll be making a bunch of proposed revisions that we believe are faithful to both the letter and the spirit of the law. We're going to put those proposals out for public discussion, and we're going to listen carefully, as we always do, to public comments on those proposals. Again, we believe that they will be, and you'll see them tomorrow. Will be public. Will be publicly. I think we have a board meeting tomorrow to do that.
Now, is this just the venture capital funds, or are also you changing the rules for hedge funds and private equity funds?
It's covered funds. It's that covered. It's not the proprietary trading part of Volcker. It's the covered funds part.
Okay. And is there a chance that banks could take this and run and maybe even get involved in mortgage-backed securities again and risky investments?
We think that what we're doing is very consistent with safety and soundness and absolutely consistent with the letter and spirit of the Volcker rule. We'll be getting comments from people, and we'll be looking into that question among many others.
Hey, Greg, Rob?
Thank you, Chairman Powell. I'd like to turn your attention back to China and the health of its financial sector in particular. And I guess I'm basing my question on reading the transcripts from 2014 that came out earlier this month. Just in March of that year, there was concern about the Chinese economy, and one of your colleagues on the FOMC at that time asked the staff about how the Chinese economy would hit the U.S. economy. And the staffer said that there was what they were worried about was that not only was the Chinese economy slowing down, but there was the financial sector. And the quote was, "There's a tremendous amount of dodgy loans in China." Now, I was wondering if you could give us an update on these problems in the Chinese financial sector, and how do you think it might impact the economy, particularly now that they've been hit by this unexpected shock?
Well, China has had a problem for some years, including from that period, 2014 up until, I guess, 17 or 18, which was essentially just a lot of debt for an emerging market, for an economy at the stage of evolution of the Chinese economy. They had very high levels of debt, not sovereign debt the way we think of it, but more business debt of state-owned enterprises and also just private businesses. And a couple of years ago, the authorities decided to try to get that under control, to stop the growth and to control it. And that, as I mentioned, that's one of the reasons why Chinese growth slowed, and it's one of the reasons why global growth slowed, because we felt that. And they've actually stuck to that even during this difficult period when they were experiencing, strains from trade negotiations and that kind of thing. The authorities have stuck to that and have, again, continued to try to do that. So to try to control the growth of debt, and that's important that they do that. We don't think that there's any imminent risk there, although, as you point out, the coronavirus thing is a significant thing, which will have some effects on the Chinese economy, at least in the short term. Chinese economy is very important in the global economy now, and when China's economy slows down, we do feel that. Not as much as countries, though, that are near China or that trade more actively with China, like some of the Western European countries. We still have, 85% of our economy is domestic. We have a much smaller external sector, trade sector, than other economies, just because of our physical location.
Okay, Brian.
Hi, Brian Chung here, Yahoo Finance. So the combination of T-bill purchases and repo operations have been described colloquially as liquidity. I'm just wondering if you semantically agree with that description. Then secondly, what the impact of that has been on risk assets. I don't know if that's something that the board or reserve banks are formally looking into, or just looking at what the effect of it has been. How are you kind of thinking about that going forward? Thanks.
Well, so two questions. I mean, in terms of liquidity, I think what we're doing is what I said. We're trying to raise the level of reserves back up to a level so that banks can meet their reserve requirements, and that there's enough reserves in the system that we don't see reserve scarcity, and we don't have to use repo operations to provide additional reserves. So I think, as I mentioned, we believe we can get to that state at the current pace sometime in the second quarter. In terms of effects on risk assets, as I said earlier, it's very hard to say what is affecting financial markets with any precision or confidence at a given time. It's not our intention to change the stance of monetary policy. These were designed to provide more reserves, and really to do that in order to enable better transmission of rate decisions into the economy under our chosen framework. That's really the purpose of what we're doing.
Hi, Jean Young with MNI. I wanted to ask about the framework review again. Would a shift of focus to inflation over an average period, would that call for a different policy stance if you made that shift? And whether or not we know the answer to that question, would the Fed consider changing the stance of monetary policy for that reason, even if there was no change to the economic outlook?
Well, as you know, we're comfortable with our current policy stance. We think it's appropriate. We think it will remain appropriate as long as data coming in are broadly in keeping with our outlook. Over time, though, let me take a step back. Over time, an average inflation targeting framework would be different than a current framework in the sense that it wouldn't be there would be some aspect of trying to make inflation average 2% over time, which means if it runs below 2% for a time, it has to run above to bring the average up. So that is a different framework. Our current framework is one where we say we would be equally concerned with deviations of inflation from target on either side. But that doesn't suggest an intention specifically to have those deviations be symmetric. In other words, consistent with that would be having all the deviations be on one side, which is what we've had actually. So I think it is a change in framework, and over time it would lead to a different approach to policy. Again, I'm not trying to I don't want to comment on the current stance of policy, which we do think is appropriate.
Don, please.
Don Leaf with the LA Times. Wanted to ask you about the stock market. By historical comparisons, as you know, the valuations are considerably high, and just wondered how much discussion and concern you and your colleagues have about that, and what risks do you see for the economy?
So we look at a very broad range of financial conditions. There isn't any one financial condition that we look at, and when we look at financial conditions, what matters for the real economy is substantial changes in or material changes in financial conditions that are sustained over a period of time. If I can, maybe I'll answer that in the context of our overall financial stability framework. That's one way to look at it. So when we look at financial stability, we've got four pillars to that. The first of which is leverage in the financial system. That is at a comfortable level. Our banks, particularly our large banks, have high levels of capital. The second is leverage in the non-financial sector, and that divides into households and businesses. Households' debt to GDP has been coming down since the financial crisis. It's not moving up. It's at low levels compared to what it was before the crisis. So not every household, but in the aggregate, household debt is in a good place, a very good place. Business debt has been moving up. We've been calling that out for more than a year, substantially more than a year, and it's something we're focused on, and we've taken appropriate measures and are monitoring carefully. But we think it's not something that would threaten financial stability, but more be an amplifier. The other one is asset prices, getting to your question. We do see asset valuations as being somewhat elevated. I do, somewhat elevated. If you look at risk spreads, they're narrow. If you look at PEs, they're high. I think the way to think about one way to think about equity prices, though, is what's the premium you're getting paid to own equities rather than risk-free debt. And that's also at fairly low levels, but not extremely low levels. So valuations are high, but not at extremes. The final factor is funding risk. Are big financial institutions and other players in the financial system funded with stable funding, or is there a lot of run risk? And the answer is very stable funding for the most part. So if you look at overall, what you see, in my view, is vulnerabilities to financial stability are moderate overall.
Katie and then Hannah.
Hi, Katie O'Donnell, Politico. I wanted to know, do you support Governor Brainerd's vision for the Community Reinvestment Act reform? And is this something that we could see the Fed formally propose at some point?
So let me say that I think this is a good time to update CRA really in a way that is a win-win, both for the intended beneficiaries, low and moderate income communities, and also for banks that would like to have more certainty about about what does and doesn't qualify and that sort of thing. The law can both be more effective and more efficient, as it comes down to. And we think this is a good way. It's also just a good time to take on board the way the delivery of banking services has changed through technology and demographic change as well. We worked very hard to try to get on the same page with the other two agencies. We think that an interagency final rule together would be the best outcome. We're sorry we haven't been able to get there, and we still hold out some hope that we will be able to. We spent a lot of time on research and analysis and looking at meaningful reform. You saw Governor Brainerd's recent speech presenting some of the thinking and the analysis, and we haven't made any decisions about what we're going to do, about whether we'll propose. I mean, our focus has been entirely on trying to get to agreement with the OCC, really. So haven't made any decisions about what we're going to do going forward. In terms of, Governor Brainerd led our oversight committee over these activities for many years, and I asked her to take the lead on CRA modernization, which is a high priority for us. I was comfortable with her speech, and I'm comfortable with the work we've done and with the Fed's position on this. As I said, we haven't chosen to bring a proposal forward. We haven't decided what to do going forward. And we're not going to comment on the other proposal. It's just not appropriate to do. It's not about us. It's not about our views. It's about the views of the interested parties.
Okay, Hannah Lang with American Banker. Thank you for being here today. I wanted to ask about Vice Chair Quarles' recent speech on bank supervision, in which he laid out some suggestions for making changes to the supervisory regime. I wanted to ask, do you agree with his approach, and are there any plans to codify some of these suggestions later in the year?
So I do agree that the principle